All right, cool. And then, all right, any other questions before we move on to how to select a pair? Cool. So when you're selecting a pair, you're going to pick a pair that is influenced by one currency in one session. So for example, GBP JPY, right? I'm going to pick that because in Asian session, it's influenced by just one, which is JPY. And then in London session and New York session, it's only influenced by one currency, which is going to be GBP, right? And then if I'm trading like GBP USD, you really wouldn't, that would be more for swing trade. That's what I reserve it for, where it's like, I know for scalping, there's a lot of fundamentals that are coming out at the same time. You know, they're really going to be conflicting each other at times too, right? Unless I get really good fundamentals in the sense that GBP fundamentals are dropping or GBP fundamentals are strong, and then USD fundamentals are dropping or they're really strong. So I want them in the inverse direction. So then that gives me a clear direction of where this pair headed. But if there's Bank of England, governor speaking, and then Fed Chair Powell speaking, and that's too high impact news, I really wouldn't want to trade around that time because that's conflicting and you're going to see a lot of, just wicks and you're going to see a slower movement anyways. So when you're picking a pair, pick a pair where it's influenced by one currency is stronger than the other. You're going to get much better movements then. And then one currency is active in the session. So if you're looking at USD JPY, for example, like we were talking about earlier, US dollar being a world reserve currency, and then that's also where you see a lot of inflow because, it's a world reserve currency, people still trade it like a safe haven currency. And then you have JPY, which is considered as a safe haven currency in general, right? So with the USD JPY, when you hop up to the weekly time frame, when you hop up to the daily time frame, you see a lot more consolidation because that's the conflicting that's happening there, where there's a lot of geopolitical tensions that are going on. There are wars that are going on. And then even within the US itself, we're starting the tariff wars with even Japan. And then we also have the economic instability where you have Trump stepping into the Fed's independence and really, threatening that. So those kind of things. So there's a lot of factors that come into play here. So easiest way, pick GBP JPY, pick Euro JPY, pick, other currencies, even all JPY, whatever else, right? Pick other currencies that are where one currency is active in that session at a time, and then one currency is stronger than the other. Use fundamentals, use economic data for that, and we're going to go over exactly how you're going to do that as well. You have different types of orders here. So if you're scalping or even day trading, scalping for the most part, you're probably going to be using market execution, which just means that when I'm going into, this is a screenshot of MetaTrader 4, but any other platform that you're using, you're going to see two prices here, right? So I'm going to select, when I click on this, it's going to be a drop down. I'm going to click market execution. That means that I want my trade to be executed at, whatever the current market price is. I'm going to pick my lot size here. So it could be, I can reduce it, I can increase it by 10 cents, I can increase it by a penny, I can reduce it by a penny or 10 cents. This is a standard lot. This is $1. I can place my stop loss, my take profit. We're going to talk about what exactly that is. And it's also part of your study guide, I believe. And then you have your buy price, and then you have your sell price here. So you would notice there's a bit of a difference. And pips, I believe, is something that should also be part of your study guide. So this is showing you a difference of pretty much 2 pips. When you see for most currencies, the 4th decimal place is going to tell you the pip change. So here, when you're looking at the sell price, it's 1.3410. When you're looking at the buy price, it's 1.3412. That's a change of 2 pips, except for JPY pairs. JPY pairs, you're going to see those numbers a little bit differently. It's not going to be 4, it's going to be around 2 decimals. So that's market execution. Scalpers use this the most. And then when you're looking at day trades, when you're looking at swing trades, you can absolutely do market execution, but some people will look at these different types of orders here too. You have the buy limit, where I'm basically saying that price is pretty much at a high level right now. I think it's going to tap into the support and then bounce off of that. So I can place an order right here, using the same exact thing, but instead of market execution, I'll do a buy limit. And then I'm saying that, let's say at 1.1 or 1.3410, it's going to drop down into the support, and then I'm going to see a push up. I can enter a buy limit here. Buy stop is that I'm seeing a continued movement, and I think that if it crosses this level here, it's going to continue pushing. So I can enter a buy stop there. Sell limit and sell stop are pretty much the opposite of the buy limit and buy stop. Sell limit, I'm saying that it's at a lower price. I think it's going to tap into a higher price, and then you're going to see a sell off from there. So I can enter an order there. Sell stop would be the price is still pushing back down. And I think when it crosses this level, it's going to continue pushing, and that's going to give me more volume to the downside. So then I enter a sell position there. We're good on the type of orders? Awesome. Now you have different types of analysis. A lot of people you're going to see moving with more of the technical analysis, trading based off of that. And there's different strategies for that too. Some people, they will do purely based off of fundamentals. So what they're doing is, for example, when you're looking at Forex Factory, you have the previous, then you have the actual, and then you have the you have the previous, then you have the forecast, then you have the actual. Before the actual comes out, sometimes you're going to see a lot more movements happening in the market, and that's based off of the previous and then the forecast, right? So that is more the fundamental and the market sentiment type of trading that's happening. Fundamental is really people trading based off of the macro data that's coming out. That would be more of the central bank, what's happening with CPI data, inflation data, those kind of things. What's happening with the central bank? Are we moving into a quantitative easing or tightening? Basically, that means, are we going to be increasing interest rates or decreasing interest rates? Maintaining that? Are we pulling out liquidity from the market, or are we putting in liquidity into the market? You have the economic data. So it could be NFP, it could be the unemployment claims that come out every Thursday. It could be retail sales, anything like that. Things that are happening from a geopolitical perspective. So wars that are happening, the tariff trade wars that are happening, those kind of things. The fundamentals are going to be the driver of the markets. This is what really creates the sentiment of the market, of whether or not the investors are going to move into a risk on versus a risk off, state of mind, or, more of the fundamental and the market sentiment perspective, right? So for example, when there's wars going on, when the trade war is going on, the tariffs are happening, those kind of things, people are moving into what we call a risk off sentiment. That basically means that people are looking for, where can I park my money where it's going to be safe? And then obviously it's going to give me a return on that money. But at the bare minimum, that it's going to be safe. When, the trade war eases out, and then we have trade deals that are happening, and then you also have, let's say right now the sentiment is that we're finally going to get rate cuts. Understanding what does that mean for the economy and what does it mean for the consumer, because at the end of the day, any sort of these economic decisions are being made from the Fed, from the government, all of that comes down to hit the consumer. What is the consumer going to behave like? The consumer is the core of the economy. So if, let's say, they drop interest rates, they are motivating businesses and consumers to, for example, go out and take out loans. They're making money a little bit cheaper for us. So if we go out and take out loans, we're taking out loans for cars, we're taking out loans for homes, we're taking out loans for a lot of different factors, right? And the businesses, obviously, to buy equipment for their business, whatever it may be. If we stop doing that, then obviously that starts impacting all the other sectors that are in that economy. So it could be the retail side, it could be the banking side, it could be, whatever. The banking, because we're not taking out enough loans. The retail side, because we're not going out and we're not spending as much money because money is expensive right now. But when you drop the interest rates, and let's say right now on Friday, we had the economic data come out where personal income was increasing a bit, and then personal spending was increasing a bit as well. That basically showed the picture of consumers are still going out and they're spending money. You would want that on the retail side. You want that in the economy. You want people spending money up until the point where you're like, okay, now because of basic supply and demand, I'm going out as a consumer, I'm spending a bunch of money. Let's say I want to buy a water bottle, right? That's the easiest example that I always give. If I'm buying a water bottle, let's say it starts off with, I'm willing to pay $1.50 for it. And then because the demand is picking up, people are going out, they're, purchasing a lot more, they're spending a lot more, the prices are obviously going to increase. Businesses are going to do that to keep generating more revenue. I'm okay with $1.50, it bumps up to $2, and I'm like, okay, cool, it bumps up to $2.50, and then I'm like, okay, this is getting a bit more expensive. You will still have sales, you probably might not have as much sales at that price level, right? And so those are the type of decisions that businesses have to make, but then also it's affecting the consumer, because as a consumer, I was okay with one price point, then second price point, at third, I was like, I don't know about this anymore, right? So then I'm going to start looking for alternatives, or I'm going to go somewhere else and do that. Do we understand how that cycle works? Awesome. And then sentiment, that's the emotions of the market participant. So again, that was my emotion as a consumer. At $1.50, I was okay with it. At $2, I was like, okay, sure. And then at $2.50, I was like, I don't know about this anymore, right? So that was my emotion as that market participant, as a consumer going out and being part and sell or buying from the retail side and things like that. What we do as traders, that's pretty much the same thing, right? As traders, when price taps into a resistance, from that support to resistance, anywhere in between, you're like, okay, I can buy this pair here, I can buy this pair here, I can enter a buy here. It hits a resistance, and let's say it's sitting at all-time high. Now, as traders, we're like, I don't know, like I'm not gonna buy this here. That's clearly a resistance. There's nothing to reference to the left. And from an economic data perspective, I don't really have much of a push here. That is our sentiment that's coming into play, and that's driven by the fundamentals, and that's driven by the fact that we're tapping into a resistance. Right. And so, yeah, go ahead. Go ahead, Vinayak. We can't hear you. Yeah, no worries. If you want to put into the chat as well, and then I can come back and answer your question. All right. And then for the sell opportunities, pretty much going to be the same thing, where from the resistance to the support at any given point, you're going to be okay with, I can sell here, I can enter a sell here, I can enter a sell here, and then it hits a support or it hits an all-time low, and there's really nothing to the left that you can reference to. Then you're going to think, okay, I'm not really sure, I'm not going to enter a sell here. So that's how the fundamentals are going to drive our sentiment, and that's how we're going to make the decision of buy, sell, or am I not just going to be part of the market today. Right. So then if there's bearish positions on equities, for example, or like in the example that I just gave on the currency side or the support resistance side, that's gonna be driven by more of the market fear, especially on equities or GBP or euro, anything that's really not a safe haven currency. If you're moving bullish on these safe haven or not these non-safe haven currencies, so like GBP, the euro, US 30, anything like that, then that is showing more of that market optimism. That is showing that from a fundamental perspective, you have a push that, okay, we can move a little bit higher. I can enter these buy opportunities on this pound. I can enter on this euro pair, or like I just don't have enough fundamentals for me to move into a market fear. I feel good about the growth of the economy. I can enter a buy on this position, right? All of that translates to what we call the visual representation of the fundamental and the market sentiment, which is technical analysis. This, I think, out of the three is the easiest thing to nail down because you are visually seeing it. You have candlesticks, you have line charts, whatever you use. Most of the time, you're going to see people using candlesticks, support resistance, break and retest, impulse entries, supply demand, whack off, patterns like head and shoulder or like inverse head and shoulder. I don't know, like what other patterns that people use. But that would be the visual representation for most people. When you're beginners, that's where they start off with, right? Trend lines, bullish, bearish, consolidation, all that type of stuff. We're good on the types of analysis. Awesome. Yeah, so I'm going to answer your question here. He asked, I want to know about high impact news like FOMC data comes positive or negative, how dollar moves, or how do we anticipate that the dollar is weak or strong? We're going to get into that when we move to the fundamental trading side here in just a bit. All right. Anyone needs a break before we hop into technical analysis?
No.
All right, awesome. So what is technical analysis, right? That's using past market trends, market data, and market patterns to evaluate the current and future trades. A lot of people get this a little bit confused between the probability and prediction. We're not predicting. From a technical perspective, you should not be predicting where a market is going. That's where you're going to hear a lot of these successful traders saying as well. You should be reacting to the market, right? Instead of predicting where it's going. So instead of prediction, what you're looking at is looking at my trade setup, which one has the highest probability of it playing out, right? That's where you're back testing, that's where you're journaling, that's where you're doing all that stuff. Whether it's also paper trading, any of that. You're studying the market to see whether it's you're trading patterns, whether you're trading, break and retest, whatever it is that you're trading with indicators, without indicators, you're looking at which trading setup has the highest probability of playing out. That's what technical analysis should be. You should not be predicting, you should be reacting, you should be studying, and you should be figuring out which setup has the highest probability of working out here. That's done through either price action or indicators. That's usually what you're going to see with a lot of people. Either they're trading naked charts, pure price action, no indicators. That's how I trade. I don't trade with indicators. I think the candlesticks are there and the market structure is there, and that's going to tell you everything that you need to know, right? From a technical perspective, but obviously you use the fundamental, you understand how does that shape the market sentiment, and then how is that going to translate onto the charts, whether I'm looking at a longer term trade or a shorter term trade, scalp or a swing. People also use indicators, so RSI, MACD, there's a couple of other indicators that people use as well that I'm really blanking out on. I shouldn't. So, you'll see a lot of that too, that you can also use as a complement to the price action, right? So one mistake that I see a lot of people doing is that they have the candlesticks and then they have like 3-4 different indicators, and then they're waiting for all of it to align, and then they're going to take a trade based off of that. One thing to be careful of when you're using indicators is that not all indicators are going to work together, and they're not going to complement each other. There are certain ones that will, right? When you're looking at volume, when you're looking at RSI, those kind of things. There are certain indicators that will complement each other, and that will give you the bigger picture of, okay, here's the inflow that we're looking at, here's the support that we're looking at. On average, this is how price has been moving, and that's going to give you a strong support. That's going to give you a strong resistance, depending on whatever type of trade that you're looking for, buys or sells. Some indicators that just don't work with each other. So really study to understand which indicators work well for your strategy and which one work together to give you the best confirmation. One indicator might tell you that it's oversold or over bought, and then another indicator might tell you, wait, there's more momentum that's about to come in. So now you're stuck between when are these two going to line up, and when can I take a trade? And then if you don't wait for that confluence, and then you just go based off one indicator versus the other, and you're already kind of conflicted, and you didn't even look at the price action. You didn't even look at the candlesticks themselves and what they're telling you. You end up taking the wrong side of the trade, right? So be very careful when you're trading with indicators. I think they can be a good supplement to your complement to your price action, but really keep your focus on the price action. I would highly recommend that, and really understand, what are the candlesticks and what are the structures telling you, and then use everything on top of that, from indicators, 1 or 2 indicators, as just more of a confirmation, further confirmation. That's it. Don't trade purely based off of indicators. That still would be my suggestion. So when it comes to price action, there's different strategies that people use. Market structure, that's going to be right across the board, regardless of whatever you're trading. So you have structure, and we're going to go into those as well. Then you have support and resistance. You have supply and demand. You have patterns. Wyckoff, I'm not sure if you guys have heard of that, but that's a really good strategy. It was developed originally for stock trading, and then people started implementing that into Forex as well. But really, it works best on the higher time frames, right? On the daily, on the 4 hour, at minimum is 4 hour, then daily, weekly, monthly, those kind of things. And it tells you what kind of distribution or accumulation phases the market is sitting in. Very basic candlestick anatomy. I'm sure a lot of you guys are aware of it, but I'll still break it down. You have a bull candle, and then you have a bear candle. So in a bull candle, let's go ahead and annotate here. All right, so in a bull candle, what you have is, for example, the price opening up down here. This is where the candle starts forming at the low, right? And then when price makes a bottom wick, that's what we call in layman terms pretty much price kicking out the sellers, right? That's your liquidity wick here. So it goes, this is the lowest point that this candle has been to in this time frame. And then it's gonna either support, or it just keeps pushing. It's taking the sellers out, it's grabbing that liquidity, and then it pushes back up above this open price, continues back up bullish. Sometimes you will see great volume. So like this candle right here would be like a healthy volume in this time frame. Sometimes you might see, a bullish candle that closes out somewhere down here, right? Or it closes out somewhere here, or it closes out as a doji where you don't really see, this body in between. This is a level where for this candle where the price is closing out at. Like I said, either it can close somewhere here, so you wouldn't see all that body, or you can close here, or when it closes as a doji, it means I just closing right at the level that it opened at. Then you have a top wick, which is the range wick that people refer to. So when I'm looking for the next trade, for example, I'm looking in this candle, for example, if the next candle starts forming, before I look for a buy, I'm going to wait for price to break above that. Now, there's different nuances within that too. If there's a massive wick, let's say if this candle closed, somewhere down here, and it formed like, let me just try it out for you real quick. So if this was my liquidity wick, and then this is how this candle closed out, and then left a massive wick right here, which you will see on lower time frames when interest rates come out, or when high impact news like CPI comes out or NFP comes out, you'll see a lot of wick rejections, right? I'm sure you guys have all seen that. So within that, with this candle, I can take an entry when this high here breaks, because then I'm waiting for the next candle to give me a bottom wick, break that high. When it breaks that high, that tells me that, okay, we can break the highest level that price closed at in the previous candle, and we can continue pushing. When it's a massive wick like that, what I'm really waiting for is more of an established support or resistance, depending on which level I'm closest to. If I'm close to a support area and price closed above this, then I'm waiting for, another bearish candle, and then the next candle to break that high and continue pushing up bullish. And the first target for me would be somewhere around here. So then I would be waiting for something like, this is where that candle closed. This is where this next one is going to open. Let's say it's something like this. I made a bottom wick. For me, it would be more of price should not be breaking this previous low. If anything, it taps into the same exact support, and then it pushes back up and it's closing somewhere here. I would want a bearish candle closure, because that previous candle closure told me that there's not enough bullish volume to close out our own high. There was enough bullish volume for price to break and come up and tap into this level, reject that, and then come back and close here. So the next candle, in layman terms, I'm waiting for the sellers to get out, right? And then I'm waiting for the buyers to kick back in. Now that we have broken above, previous resistance, which is now a new support. So the next candle, same thing. I don't want it breaking the previous low, but at most it can tap into it and then continue back, pushing back up bullish. This is where that bearish candle has closed, right? So this is where the bullish candle closes. This is where the bearish candle closes. Bullish candle basically means that price is closing above the open price. With a bearish candle, you're saying that the price is closing below the open price. This is where your open price is. Now for this, I'm going to wait for price to break that previous high somewhere here and then continue pushing. As it does, my first target, depending on how big the previous top wick is here for the bullish candle, I can target that. That's your basic 1-to-1, 2-to-1, whatever it is. You're going with that, right? With your stop losses below these previous lows, because once again, if price breaks the previous low, that tells you that the sellers are more in control right now and we're pushing back down. Price is not just yet ready to keep pushing. You will see a lot of wick rejections when high impact news comes out, but outside of high impact, let's say the market has just opened up and like the stock market, or there's a lot of low impact news. You're about an hour into the session. There's just low impact news. There's not a lot of red folders that are coming out. You would want that healthy movement where price is not really breaking the previous lows in a bullish structure and it keeps pushing back up, right? So that's what you would want. This would be your classic bullish break and retest structure, and that's what you would be trading. Right now, the candle body themselves could look very different. I just gave you an example of a healthy bullish candle and then not so healthy, where you have a top wick and then you have it closing out, with a very little bullish candle body, and then the next one giving you a bearish and then a continuation up. Sometimes it could simply be a healthy one. So here, for example, instead of that being, bullish, this one could be bearish, and then it just makes a bottom wick right here. Sometimes have a top wick, sometimes not have a top wick, and then the following candle could be bullish, and that could still be a valid entry that you're looking at. So this is where that candle body would open. It breaks these previous highs, and that's the entry that you're looking at. Does that make sense? Cool. Now think that, but opposite for the bearish candle. So on the bearish candle, this is where your price has opened up, and then you have open, and then this is where the candle has closed. Now, where you had that liquidity wick down here on the bullish candle, it's going to be at the top for the bearish candle. You're rejecting the buyers pretty much at this level, and then you're pushing back down, and this is your range wick. So the break and retest that we saw with the bullish candle, with the green candle, red candle, and then green candle again, think opposite here now. So what you're looking at is we have a bullish candle or a bearish candle here. Now I'm going to create a bullish candle. This is where the candle closed out. The next one starts forming. Maybe it corrects that and gives me a top wick somewhere here, and then also a bottom wick somewhere down here, kind of respecting these previous lows. So now this would be the last low that price has pretty much created within this time frame of these two candles. Now these two candles can happen on a 5-minute time frame, it can happen on a 15-minute time frame, it can happen on a 4-hour time frame, it can happen on a daily time frame. It really just depends whatever time frame that you're trading based off of. And it also depends on whether you're looking for a scalp. If it's a scalp, you're looking at the 5-minute, you're looking at the 15-minute, you're looking at the 30-minute, you're looking at the the 1 hour. If you're looking at day trade, then you're looking at 30-minute, 1 hour, 4 hour, right? If you're looking at swing trade, then you're looking at the 4 hour, 1 hour, daily, weekly, whatever, right? Really just depends on what kind of time frame that you're looking at. So now in this case, if I'm going to look for a sell, now I want price, this is where the candle closed, this is where this next one is going to start forming. I would want price to break its own low right here and keep pushing. Maybe give me a top wick, really respecting these previous highs here. When that happens, this is where I'm looking for the sell. But notice how in the first example I gave you for a bullish, my stop loss was also pretty tight, right? But here it would be a little bit wider given the volume that we're seeing in these candles. So now either you wait for that candle closure or you wait for price to break this low and then you're going to have a wider stop loss. If I wait for the candle closure and then I wait for the next one to start forming, I would want a top wick rejection here, right into this previous support, which is now the new resistance, and then I would want it to keep pushing down. If that happens, I can keep a tighter stop loss somewhere around here. And we're going to go through all of this on the simulator as well. We're going to take a quick little break in between, but I'll show you guys exactly how this would work out in the live markets too. So then in this case, I would place a stop loss here. What I'm basically saying with the stop loss is if price pushes past this specific level, this trade for me is invalid and I want to get out. A lot of times people will keep a wider stop loss, right? It really depends on your preference and also depends on what your risk management strategy is like. For me, I work backwards from the fact that I will look at where does my stop loss need to be? What's the highest probability of this trade setup working out? Where does my stop loss need to be? And then based off of that stop loss, where am I going to be taking the entry? Most people, they're going to look at the entry first. And then they're going to figure out the stop loss. And then, they're going to look at the TP and all that stuff. The reason why I like to work backwards from that, from the stop loss to entry and then to take profit is because I want to make sure that there's the lowest probability of price pulling back in the opposite direction and then taking me out. Sometimes that means you're waiting a little bit longer. Sometimes that means that you're waiting for candle closures instead of just entering on the first candle. But I'm waiting for the most confirmation before entering into a trade. So then that gives me the highest probability setup to enter that trade and make sure that I'm not having massive, losses, or my wins are still going to outweigh my losses. Losses are inevitable in this market, in financial markets. It's going to happen. You can't avoid them, but it's more of how are you managing those losses and how are you making sure that you're still trading based off of the highest probability winning setups. Cool. Any questions there? Awesome. Yeah, I see. Oh, I saw a raised hand. All right, now coming into structure, basic support resistance. So you have 3 really structures, and you're always going to see the market kind of flowing into each other in different variations of it. So on the bottom, I have a chart for you guys from actually like TradingView of an actual chart of a pair. So that shows you that first we start off with the bullish structure. So when I was talking about higher highs and higher lows in your study guide, this is what I meant. So here you have price establishing. All right, there we go. So here you have price establishing some sort of support first. So if we're looking at this example here, price has established some sort of support here, and then it pushes up, and then you have that high. Right? That's your first low, that's your first high. In this case, it would be right here. So after establishing a support here, it pushes up. This is going to be my first high. This is what I'm using in reference to the rest of the market structure. After that, when price pulls back, price is going to correct. It's going to collect orders in 2 ways. It's either going to give you a retracement or it's going to consolidate. When it gives you a retracement, that's the healthy structure. So in this case, price pulls back, but notice it doesn't necessarily break the previous low. In the live markets, it can come back a little bit deeper and tap into the previous low, right? But it's not necessarily going to break that if there's no other fundamental driver for it. If there's nothing else from an external factor besides the technical analysis that is driving that. So in this case, you do get a pullback here, and then you establish a support, right? That is now your higher low. So this low is higher than the previous one. That's why higher low. And then after establishing that support, it's going to push up and it's going to establish a new high. It's going to establish a new resistance here. And that's what price did here. Shortly after, we pushed up and we established a new resistance. It's just a little bit higher than the previous one, right? But it's still nonetheless a new high. And then again, it pulls back, establishes a new low. So now you have a higher high, right? This high being at a higher level than the previous one, and you have higher lows. Low being at a higher level than the previous one. And that just keeps happening until you tap into a resistance, and then you tap into either, a resistance or, if you're trading supply and demand, going off of that, until you tap into a level where pretty much the buyers are out and they're like, okay, this doesn't make sense to me anymore. I'm not going to continue with these buying, right? We're going back to the water bottle example. 150 is fine, $2 is fine, 250, you're like, I don't think I'm going to do that, right? That's where you're going to see a lot of profit taking happening as well. So people are going to start exiting those buy positions. They're going to be like, okay, it's really not going to push any higher. We've tapped into, maybe a higher time frame resistance. It just keeps pushing. There's no fundamental driver for this. It doesn't really make sense for us to do this right now. So then in this example, we transition from a bullish structure directly into a consolidation. In a consolidation, you see that price isn't necessarily breaking any previous lows. It's also not breaking any previous highs. It just ranges within that. And that's exactly what's happening here. Price is just consolidating. Here's your previous high, top wick rejection. That's the same level that we tapped into. And we're just holding on to a support here, all right? Until you're consolidating, market's collecting orders, we're figuring out direction. Are we going to have more buyers kicking in? Are we going to have more sellers kicking in? At every single price point, even in the bullish candles here, and even in the bearish candles, there's constantly buyers and sellers, right? There's always going to be buyers and sellers in the market. But now it's a matter of, are the buyers taking over or are the sellers taking over? In this case, we had the sellers taking over, and you saw the bearish pressure. In that bearish pressure, think of opposite of the bullish. You have a resistance formation, so a high that was formed, and then a new low that was formed. Those are our reference points here. And then price is going to push back up, and it's going to create a lower high. So a high at a lower level than the previous. And then pushes down even further and taps into another low. So now in the bullish structure, we're breaking the highs. In this structure, we're breaking the lows, right? And then price pulls back up, same thing. It can tap into the same exact high. So this could have came a little bit higher and tapped into the same exact previous high. But in a bearish structure, we don't want highs to be broken. At most, tap into it and then reverse back down. And that's exactly what happened here too, right? So even if you're looking at this example in this bearish structure, price came back. So you had this entire push, and then you had these high formations here. You got wick rejections. That's the highest level that price had been. If I extend that out, that's the same exact into. And even within this bearish structure, it started consolidating a bit more. Again, looking at, well, we've tapped into this high. Are we going to have more buyers? Are we going to have more sellers? And then you start to see that consolidation. And then you start to see that the sellers have taken over once again, and you continue with that bearish structure. So they're always going to move into each other. So sometimes instead of a consolidation, you might even see a bullish structure and then a straight push down, right? Let's just go back real quick. A straight push back down here. Or sometimes you'll see, a bearish structure and then a continuation right into a bullish structure. Sometimes in between you'll see consolidation, especially if price is just not ready to move and you're looking for a fundamental driver to kick in, economic data to kick in. This could be, a push up and up until the Fed was going to come out with interest rates. We start consolidating, trying to figure out, are they going to cut interest rates? Are they going to increase interest rates? All that stuff. You see consolidation and then price pushes back down after interest rates came out. It could be the same thing with NFP. It could be the same thing with CPI. It could be anything. It could be the same thing with any of the high impact data that's coming out. Any questions on the technical analysis side? Awesome. Let's take a quick 5-minute break. I'm going to go grab some water and we'll be right back. All right, this is Soft Forex. This is a simulator that is used for Windows. It works best on Windows. If you have a Mac or something else, then you can use the Trading View Replay, or there's one more called, I think it's called FX Replay. You can use that as well. But I really like this because I think it really shows the real markets and has the news with it. So you can go back and you can take a look at news if you wanted to back test any specific news, if you wanted to just see market structure during specific sessions. So it has that here as well. I just picked a random date for the beginning of the week, and then doing that. We are going to look at GJ. I think that would be the easiest compared to like US 30 or gold or like some other things that you guys have seen me trading before, at least from a beginner perspective. And then you also have you have the news, you have the charts, you have the trades right here. So if I click on that, it'll show me the history, and it will give me all the stats that I want for my trades as well and for my account. And then it will just show you like versus your balance, your equity, all that stuff. Like you'll see a chart here ultimately. So this is going to tell me like what are my realized profit and loss. Realized means that I've closed out the trade, right? And then my losses and my wins based off of that. Unrealized means that it's kind of just running. I haven't closed out that trade just yet. My total profit and loss, it will tell me the total amount here. Let's continue down. What else would you need to know? Your gross profit, your gross loss, the number of my profit trades, number of my loss trades, all that stuff. My consecutive wins, my consecutive losses. So it'll tell me all that stuff here. And then I think sessions, yeah, I showed you guys that right now. Another really cool thing that I like about this is I like to go off of percentages, and we'll see that on the risk management side too. So you can pick your lot sizes here. We're starting off with the $5,000 account. You can start off with the lower one. You get to pick that when you're setting up your simulator, whatever you want, your leverage, all that type of stuff too. So for lot sizes for this, I always switch to the percentages. So then I'm always risking between 1% to 3% of my account size. That way I don't really have to worry about the lot size. There's a very high chance there's probably going to be only a couple of cents. But I always like to go with 2%. That's the sweet spot. 2% of my account, that's what I'm risking. You also have visual mode. So on visual mode, let's say, for example, I'm just going to show you real quick. If I hit a buy or something, right? It's going to show me these two lines. I have the blue line, which is my take profit. So here I hit a buy. That's why my blue line is above my entry and my stop loss. If I hit a sell, it would be the opposite. And then here's my red line, which is my stop loss. So I can place that. And then wherever my entry needs to be, basically, or whatever my stop loss needs to be, it'll tell me that. Yeah, that's pretty much it, I think, here. Yeah. And then instead of ticks, I'll do real time. And then if you want, you can speed it up. Sometimes I put it at 4 just so, and it depends on like, what am I coming into the simulation session with? What am I trying? What's my focus here? What's my objective for the simulation session? So sometimes I'll speed it up. Sometimes it's like, what you'll see in the live markets is if you keep, practicing on these simulators, you get used to the speed, you get used to, the fast environment because you're skipping through and you're doing all that stuff. You obviously can't do that in the live markets. So then that would be something that, you can practice with. So you can, just keep it at 1. That would be your live charts. And I'm practicing just, getting through the session and seeing like at what time will I end up seeing a trade, at what kind of time am I looking at a setup, with news 15 minutes before news comes out. Is there a lot more volatility? 15 minutes after the news comes out, is there a lot of volatility? Which trade setup do I want to enter? So you can practice, different things. If I want to practice just risk management, I can do that. So then coming in with an objective, I think with every simulation session is very important, because then now you get to take notes. You know exactly what you're looking for versus I'm just going to go and back test. Okay, what are you back testing for? Right? So there's a lot of different factors. So be very objective, be very intentional with whatever you're trying to do. All right, so then we have all these different time frames as well. So we'll do an entire top-down analysis. You can also save this at the end, so you can do save simulation and then just keep building out that account. Or you can do lot sizes, you can do the risk dollar amount, all that stuff too. Okay, cool. So whatever we just did on the slideshow part, I'm going to do that here with you guys on the simulator, and we're going to do an entire top-down analysis together. We're going to start off with the weekly time frame. So this is what the weekly time frame for JPY looks like back in June, in the beginning of the week. And so here, what kind of market structure are you guys seeing? So tell me from the left to the right what's pretty much happening here. And feel free to annotate as well. All right, seeing a bullish structure. Okay. Here with your basic support resistance, where would you place your support? Where would you place your resistance? Yeah, bullish initially, now consolidating. That's perfect. Where would you place your support? Where would you place your resistance? All right, all the way up there. Cool. And then you have your support down here. Awesome. Now, these levels are right. What I teach my students is you want to look at the current price level. You want to look at where is price right now and what level does it need to break right now before it can go all the way up top there. Perfect, Yanette. Yanette is also part of the group. She's nailing it lately. All right, so you got that resistance. So this is the most recent resistance. This is what price needs to break. This is a weekly time frame. This is what price needs to break this week in order for us to continue bullish. So before we're even headed all the way up top there, I'm not saying that's wrong. You're absolutely going to get there, but it's a matter of, when I'm looking at what trades am I looking at this week, this day, in the next hour, depending on my style of trading, I want to look at where is price right now and what levels does it need to break right now before it goes up to these higher time frame levels. So that would be the resistance right there. And then for support, I'm looking at where's the bottom wick, where's the previous support, all that type of stuff. So here, the weekly bottom wick is right here. And then if I look to the left, it lines up with this previous resistance, right? It also lines up with the support. So before I'm headed all the way up top there or all the way down here, I need price to break these two levels, and this is what my range for this week is going to be. Does that make sense? Awesome. So now I drop down to the daily time frame. From higher time frames coming down to lower time frames, you can always adjust your levels too. So then if I'm looking at a weekly time frame, I made my support here. On the daily, I see that, okay, that's where the previous daily bottom wick was, but the current candle is holding onto a support here. So I just adjust that level up top here, right? And then I say that this is where price is sitting at right now. The resistance seems to check off on the daily as well, so I don't need to do anything there. But when you're thinking about coming from higher time frame down to lower time frame, think about it like a box. So when you're marking off your levels, make sure that your daily level isn't above your weekly resistance. That wouldn't necessarily make sense, right? So if this is my weekly level or my monthly level, and here's my resistance and here's my support, my daily should be within those same parameters. It should be within that. It should be getting smaller, right? And then when I come onto the 4 hour, it should be within the daily parameters. And then when I come down to the 1 hour, it should be within the 4 hour parameters. And then when I come down to the 30 minute, it should be, within that. When I come down to the 15, it should be within that. If I come down to the 5, it should be within that. At no point should lower time frame levels be higher than the higher time frame levels. That wouldn't make sense, right? Because on the lower time frame, first I need to break the 5 minute high, and then I need to break the the 15 minute high, then I need to break the 30 minute high, then I need to break the 1 hour, then the 4, and then the daily, then the weekly. That's how it would work, right? Same thing for support. I need to break the 5 minute, then the 15, then the 30, then the 1, then the 4 hour, then the daily, then the weekly. That's how that would work. So whenever you're marking off your levels, after today's boot camp, make sure that you're thinking about that box, and necessarily what you're doing is just narrowing in as much as you can to figure out, here's my no trade range, and then these are levels that need to be broken for my scalp buys, my scalp sells, my day trade buys, my day trade sells, my swing buys, swing lows, those kind of things. Swing buy, swing sells, those kind of things. So now coming on to the daily time frame, same resistance. We adjusted the support down here. There's really nothing else I would be marking off on the daily time frame. Now I come on to the 4 hour. So here's my daily resistance and here's my daily support. Within this, I'm going to look at where's the current price action and where are the levels that need to be broken right now. So what do you guys think here? Looking at the current price action, what is the resistance that you would mark off and what is the support that you would mark off? Perfect. Not all the way up there yet, but the candle bodies. So right here. So price needs to break this before we can head down to that wick, right? If it breaks below this at a lower time frame, we're probably going to be targeting the wick as more of our TP1, right? Or taking partials. And then you have your resistance, which is right here. So these are my four-hour levels, but we see how it's within the daily. So what I'm doing now is I'm narrowing it down even more, because if price breaks above this 4-hour resistance, then I can target, this resistance here on the daily time frame. If price breaks below this 4-hour support, then I can target this daily support as my take profit. So now I'm narrowing it in as much as possible. You don't want to do it too much. Obviously, you don't want to narrow it down on a 5-minute time frame or a 1-minute time frame. I say for even scalping, stick to the 15-minute. 5-minute, you will see me doing that. But what I'm doing there is I'm not taking an entry based off of 5-minute confirmations. I'm taking an entry based off of 15 and 30-minute confirmations. And then the 5-minute time frame serves more as the volume, just checking the volume. Can we continue breaking our own highs? Can we continue breaking our own lows? So James, I see you marking that off. We wouldn't be marking that off here because price is so close to the next major resistance. So that's why I'm marking that off. That's where the current price is. We still want to give it a little bit room. Now we come onto the hourly time frame. So now based off of the hourly time frame, the support checks off, right? And then we had a pretty good push. It seems like we're correcting this bearish pressure. And then we have that resistance, which also checks off, which is that support, break and retest resistance. You had a top wick rejection and then a push back down. So overall, we're seeing that these levels are starting to check off here, right? Pretty good. Now we come onto the 30-minute time frame. And now I'm looking at the 30-minute time frame. We got a break and retest here. I come down to the 15. There's no resistance or support that I'm worried about just yet. Basically, what I want to look for here, now that we're approaching this level, think of like that water bottle example that I was telling you guys about, the 150. That's pretty much here. You're like, yeah, of course I'll buy that. $2, somewhere around here. You're like, okay, sure. $3 or $2.50 or $3 or whatever, you're approaching this level and you're like, okay, I'm not really sure about it, right? This is where your decision making really is driven by the fundamentals and your market sentiment, whether you're going to be looking for buys on a technical perspective or not. So before that happens, you need this resistance here to be broken and then a continuation to the upside. If that happens, then obviously you have your buy opportunities, you're targeting these previous highs and a continuation up. If you see consolidation like we do here to the left, if you see that consolidation formation here, that's pretty much the market telling you that I don't have a directional bias just yet. I don't have enough confirmation of whether the buyers are taking over or the sellers are taking over. Instead, you're going to see that bit of a consolidation, and then either you push above it, then you have your buys, or you break below this level, and then you're looking for your sells to the downside. So let's go ahead and play this out. Session wise, we have Sunday opening up. So this is Friday's New York session. So in Sunday, we're going to have the Asian session opening up in about an hour. So let's actually just go ahead and skip about an hour. So we get to the Sydney and we get to the Tokyo and all that stuff. I'm going to speed it up just a little bit for time's sake. We have a bunch of stuff we need to get through today. So Sydney's not really going to have a lot of volume. You're going to get more volume when the Tokyo session opens up, and then you're also going to have the Tokyo Stock Exchange opening up too. So that's what we're eyeing. That's what we're watching out for. So as you can see, there was a massive gap that happened. This was the candle that we're looking at. That was Friday's closure. And then today you got a gap that happened. The gap happens because over the weekend, like I said, there's constantly trades that are being placed. But right before the market opened up over the weekend, I say weekend because for us it's a Sunday when the Forex market opens up, we had enough sellers in the market where price pushed all the way down here. And then from that point, you had a little bit of a bottom wick here too. And then the buyers took over. Again, looking at the water bottle example, we came back to the 150 or even lower, and we're like, okay, yeah, of course, I'll buy this. And then you see that push up happening. This where that candle closed, the bullish candle. Then you had another gap that happened. So again, sellers kicking in once again. And then from here, you got that push up once here, right? We didn't necessarily fill in that entire gap, but the next candle, here's where that candle closed. The next one opened up right here and then closed right here. And then the next one, the current one, gapped down a bit more and then pushed back up. So the lower the time frame, the faster these gaps are going to be filled. If you see a gap on, the daily time frame, the 4-hour time frame, those are going to take a little bit longer. But always understand that at least in the Forex market, the gaps are always going to get filled. It's just a matter of time. So it's the first session of the week. What I tell people all the time is don't trade the first session of the week, which is the Asian session, because that's when the market is, if there's a lot of fundamentals that came out over the weekend, that's when the market's really going to be pricing them in. All right, so give it at least that first session. Don't really trade that. So with that being said, I'm going to skip over to, let's get to the Asian and London session. So then we can see, now we have two sessions that are going to be open up at that time. And I want you guys to see the difference in the volume around that. All right, here we are. So we come back, and this is about an hour before the Tokyo and London is going to open up. I want you guys to notice the difference in the volume as the market's getting closer to a certain market open or a certain overlap or a certain close. So here you had that little bit of range bound trading that we're kind of talking about until you had the Tokyo session open up. You had a little bit of consolidation. That's when we really got the push and then pull back down. And then this was the rest of the Asian session. Now we're coming close to an hour before the London and Tokyo, or London and the Asian session overlap. So now you're starting to see that consolidation, but even within that, we're still maintaining this bullish structure to the upside. Does that make sense? Perfect. We are having a few more people. There we go. All right, let's skip, get closer. Now you start to see more of that consolidation. From a news perspective, it's going to be a pretty easy day, right? Nothing really happening until the Asian session, the following day. So on Monday. All right, so you get that push. Now we're getting closer, about 15 minutes before the London and Tokyo open. What we're looking for is we had that entire little consolidation here. We got that candle closure. Now, what we were talking about on the candlestick anatomy slide, right, where I was drawing out the candles, here, in order for us to look for a buy, we need that bottom wick formation, right, kicking out the sellers, the liquidity wick, and then breaking these highs. As that happens, you have a buying opportunity here. What I'm going to be careful about here now is that in the next 13 minutes, I'm going to have the London session opening up. Right now, it's not the most volatile. Most volatile session is, again, during New York and London overlap. This is the most liquidity. So I'm expecting a lot more volume. What Asian session did today is when the market opened up, it corrected, the massive seller's pressure. It corrected that. And then same here, we kind of range bound movement. We got a little bit of volume and then we came back. We held onto a support. We maintained a bullish structure. And now London's job is just to carry that forward, right? Because we don't have any other fundamentals that are coming out. So I'm going to wait 11 minutes. I'm going to wait to see what happens when the London session opens up. And then I'm going to look for my trade opportunity here. All right, so you got that nice push. here is your Tokyo and your London. Sydney is closed now, but Tokyo session is still open. So you still have, the Asian session still going on. Now here, what I'm looking for any continued buy opportunities is you have that previous resistance, the previous high that price has formed. Now we're looking at a healthy bullish structure. What I want to see is either a pullback, a bearish candle closure, and then a continuation up, and that's the buy opportunity. I don't want to be buying at a high, or what I'm going to wait for is a bit of a consolidation and then a push. In a healthy market, you want the retracements. Those are good. A lot of people, when they're in a trade, you get scared. You're like, I don't want a retracement, right? But those are good. As long as you understand like where your entry was taken, and then if the retracement does happen, your trade still needs to be valid for you to continue holding on to it. If for example, if you took a trade, excuse me, if you took a trade somewhere here to the top of this range, and then that, okay, we're tapping into previous highs, that's a higher time frame resistance that we're coming into, and price is going to pull back. Obviously, you do want to close out your trade while you're still profitable, because you know that there's going to be a retracement that comes in. Consolidation, you're going to get that happening when we don't have enough sellers to correct this bullish momentum, or you don't have enough buyers to correct the seller's pressure, right? So consolidation happens where price is pushing, and it's like, okay, we're exhausting out at a specific level, and I need, some more orders. I need to really figure out the direction of it, but I don't have enough sellers to correct that move down. You're going to see consolidation, and then you're going to see a breakout of that. Any questions so far? All this makes sense? Too much information all at once? Or what's going on here? Okay. All right, we have tapped into these previous highs. It seems like we're pulling down, but once again, you don't have confirmations of sales just yet. This level is that daily level and the weekly level. So we know that just a 15-minute break isn't really just going to take us to the moon. It's not really going to bring us all the way top here. Instead, we need those candle closures. We need that continuation. We need that break and retest. We know that we need that broken resistance to be confirmed as a support prior to a continuation up. So another thing that I see with a lot of traders is that, these higher time frame levels, higher the time frame, the stronger these levels are going to be. A 15-minute, 5-minute, 1-minute break is really not going to take you all the way to the top, right? A lot of traders end up doing that. So just understand that's not going to happen. Just understand that when that is happening, though, you will get better trade opportunities, because that means either price is going to reject that heavily and then push all the way down. Not all the way down, but like it's going to drop significantly, and you have those sells that you can take advantage of, or price is going to establish a support here, and then you have clean momentum to the left here that you can follow to the upside. So don't get scared like when price taps into all-time highs and lows or higher time frame highs and lows, and then think that, okay, nothing's really going to happen. You do have opportunity. The whole thing about risk management is also understanding what is the limitation of your trade too. So now here, see, we still haven't broken previous lows. So we rejected into that area. And now this is, the bearish candlestick anatomy chart that we're talking about. If this breaks the low as it is right now, then you take that sell and you're bringing it back, and you're thinking, okay, what is the next level that price is necessarily going to tap into? So for example, if I took a sell here, I'm thinking about where's my stop loss going to be? My stop loss is going to be somewhere here. And then I would be targeting, somewhere around here as well. Previous supports. Let me mark it off. This is kind of the area that I would be targeting, which is a support area, right? And then I'm placing my stop loss there. So see, I have a big enough range to take a trade on this. Let's say I'm going in with a penny, which is pretty much what you're going to be doing probably on majority of your pairs, especially if you're starting off. You want to start off small. You have that. You can bump it up to 2 pennies, whatever. Let's take a look at what that 2% risk is going to look like here. So let's say I place that right there. My TP somewhere around here. I'm going for a 1-to-1, right? And this is again, just for beginners. So like if, you're looking for a 2-to-1, 3-1, you're pretty much following the same process. It's just that this is just for beginners, right? Targeted for beginners. We're trying to really break it down for you guys. So here, the confirmation was, we got the massive push up, we created a new high, we're just following basic structure. This one has broken the previous low, and we're looking at what is the next support area. In this case, it was this. Right after that, it would be down here. After that, it would be down here. All this is making sense to you guys? Any questions? Awesome. I'm just speeding it up a little bit to see what market's going to end up doing. But even with just at the 4 times the speed, even if you're trading like gold or US 30, something like that, that's going to move a lot faster, right? So those are a lot more volatile. If I was trading GBP USD or Euro USD or like any of the major pairs, I would probably have to speed this up a lot more too, because those are going to move a little bit slower. So this still is moving a lot faster than major pairs. And then we can check the remainder of the week too. And you can increase how many future events you want to take. So like I can do 50, I can do 75, anything like that. And it'll tell me on a day-to-day basis. So then in Asian session today, we're going to get interest rates. Then the next day we get core retail sales from the US. GBP is going to be CPI. Thursday is unemployment claims. And then FOMC interest rates. All that stuff. All right, so we got a massive push down. In the examples we saw, there were wick rejections. Sometimes you might not get a wick rejection. That basically means that in this 15-minute time frame, price closed at its lowest that it could, right? And that's where you need to be careful, even for buying opportunities. If they just push up with no bottom wick at all, then this is where you need to be careful, because at this point, that's the lowest that we closed at. The next candle can bring you up a little bit higher. Buyers can kick in the price a little bit higher until you see the sellers kicking in again, right? Or the next candle can just start off with no top wick again and continue that bearish momentum from the previous candle with no top wick and just continue pushing further back down. I like top wicks because then that tells me where am I going to place my stop loss, where were the buyers rejected, those kind of things. And then on a bullish candle, I like to see bottom wicks because, again, where can I place my stop loss for buys? And then also, where did the sellers get rejected? We're just a little bit over time on this agenda, but we should be fine. All right, so you have about 8 minutes until Tokyo session closes. Asian session is going to be closed, and it's just going to be London for a few hours until you get the New York session opening up. I'm going to skip through just so we can stay on time, and then also get to the fundamental side too. All right, so you got the TP hit, got a little bit of consolidation, price continues pushing. So as you get more advanced in your trading, so to speak, you'll learn how to like increase your TP, you'll learn how to move to break even, you'll learn how to do all that stuff too. But session-wise, now you have the London and New York overlap. So now you're going to see the difference in the volume here too. I'll just skip through just a little bit just to show you guys, but you're going to see a lot more volume kicking in about 45 minutes, because that's when the New York Stock Exchange will open up. That's when we tend to see a lot more volume in the market. So around this time, 30 minutes in. So then now you have rest of New York. But let's zoom out so we see the full picture. This is when the market opened up with just Sydney. And then around here was your Tokyo open as well. Push back down. All of this was just Tokyo. and then Asian session, and then this is where your London session opened up, and then you had a bit of your London and Asian session overlap, then you had just London, and then you had around this time the London and the New York, and then you start to see that movement, but you see the volatility a lot more versus the previous candles where they were just pushing and all that stuff. There's a lot more volatility, but there's a lot more volume. Look how quickly we have also pushed up here. Looks good. Any questions about this? All right. Anyone need a break before we move on? Okay. Let's get through fundamental analysis now. Fundamental analysis, as we talked about, those are going to be the drivers of the market. This is economic, social, and political factors that will affect the supply and demand of an asset. So that could be, when you're trading stocks, for example, it's pretty much the same thing, right? It's when you're trading GBP, JPY, same exact thing, right? If you're trading gold, same thing. If you're trading US 30, same exact thing, right? So all these factors are going to make up whatever pair that you're picking as a good economy versus a weak economy. Not a bad economy, it's just, it's relatively weaker than the previous one. So when we were looking into sell opportunities on GBP, JPY, in that time frame, we knew that it was a bullish structure and there was going to be a bit of a corrective move. That sell opportunity, even if it was short term, we're basically saying that at that point, the pound was overbought. And so we saw that, that was weakening. The strength there was, so to speak, weakening. And then we saw that, obviously we're going to look for sells. So we're saying that the yen in that time frame, in that short period of time frame, is a bit stronger than the pound, right? So that's your good economy versus the weak economy. When you're looking at the bigger picture, when you're looking at swing trade opportunities, when you're looking at the daily time frame, the 4-hour time frame, when you're looking at the weekly, that's really when major fundamentals, understanding, from a macro perspective, macro just means the bigger picture, understanding all of that is really going to come into play, because then you're trying to hold out your trade even longer. You want to be trading, or when you are trading these pairs around, news release. So like, for example, in the remainder of the week, we saw that there was going to be BOJ news, there was going to be retail sales, there was going to be unemployment claims, there was going to be all, Fed interest rates coming out, all that stuff. All that stuff are the fundamentals that are going to be pushing your pair. So when you're trading around that time, you really want to be comparing those fundamentals between the two economies. So around, the UK, the pound versus Japan, the Japanese yen. This is broken up into macroeconomics, microeconomics, and geopolitics. We're going to go through all that stuff too. But as I was talking about earlier, the consumer is really the core of the economy. The way that this cycle works is that us as consumers, we make decisions based on, our income, our spending, and then what our sentiment is when it comes to, can I afford this right now or not? So as a consumer, going back to that water bottle example, I walk into a store, the retail side, and I see $1.50 bottle. Sure, buy that. $2, okay. $2.50, I don't think so. $3, I'm not doing that. I'm not paying $3 for a water bottle, right? A basic one. Those were my decisions based off of the factors of the pricing, what my income is, what I can afford, what my spending habits are like, and do I think that I need to save money basically right now, right? Onto the retail side. So if I'm buying water bottles at $1.50, the retail side, they're getting, it's booming business, and they're like, okay, we need more. We need to restock, right? We need to restock. They go to the manufacturing side, right? The producers, wherever they're getting it, the wholesalers, whatever, right? They're getting it from them, their product. And so they keep placing these orders. And then the number of orders drops at $2.50, right? Because from $1.50 to $2.50, we had a little bit of uncertainty in between, where around $2, we're like, yeah, sure, like we'll do that. But $2.50, we're like, I don't think I'm going to do that. $3, like, absolutely not. We're not going to do that. So my decision as a consumer trickled over to the retail side, which then trickled over to the manufacturing side, right? And then after that, it goes into the rest of the economy. On the manufacturing side, if I'm not getting enough orders, then obviously there's not a lot that I'm producing. There's not a lot that I'm manufacturing. And then now at a broader scale, the decision-making comes in when it comes to the employment side, when it comes to, again, circling back to the consumer, because I'm a consumer when it comes to the retail side, but I'm also an employee. I'm also part of the economy. I'm also working somewhere, right? Whether you're working a corporate job behind a desk or you're working on the manufacturing line, everyone has a job. You're doing something, right? You're part of the economy. And so maybe I'm working in a manufacturing company, right? I'm working on that line. And so if there's not enough orders coming in for my manufacturing company, then obviously at some point, looking at the state of the economy, the business is going to have to make a decision. Where do we cut our cost, right? There's too many costs. We don't have enough orders. What are we going to do? That's pretty much what was going on in this past year within the US economy and a lot of major economies too, right? Where it was the spending, interest rates were high and money was expensive at that time. And a lot of the consumer, the income was not matching the spending or, the level of liquidity that we have in the economy. And so a lot of consumers, they were taking a step back. A lot of consumers had, stopped purchasing as much, whether it's small products, whether it's big products like cars, or if it was like housing or whatever it was, right? We had that problem that was going on. That trickled over from the retail side to the manufacturing side and then to the rest of the economy. Obviously, if businesses are not getting enough business, if they're not getting enough orders, if they're not having enough consumers come in and buy their products, whether it's housing, whether it's something small as a water bottle, doesn't really matter, a coffee cup, whatever. If you're not getting enough of that, then you're going to start making decisions based off of that, of like, how do I cut my costs, right? And you're looking at fixed costs versus variable costs. My rent is fixed. What I'm going to be paying for lights and all that stuff, to a certain degree, it's fixed. Whether it's variable, how many people that I'm hiring, I can lay people off, right? I can fire people because I just can't afford that right now, right? Looking at raw materials, right? Some of those things, it's going to fall between the fixed cost and the variable cost. Fixed cost, I can't really do much about. Variable cost, I can absolutely do something about that. And that's where the businesses are going to be making their decisions initially and before they move on to fixed costs. And that could just basically mean like, I can't afford this rent for, this location of this business anymore, so then I'm moving out. But that tends to come later into the cycle. We understand this flow. Any questions? Awesome. So breaking down macroeconomics, we're looking at interest rates, we're looking at monetary policies, and then we're looking at inflation data. Interest rates that dictate the inflow and the outflow of a capital in a country. So for example, if I'm looking at GBP, JPY, for example, right? With GBP, let's say the interest rates are, I'm just making it up, are sitting at 0.25%, right? Versus with Japan, it's negative, 0.1%, something like that. So now looking at those two interest rates, obviously I'm going to go park my money with the positive 0.25% because I know that I'm going to be getting a return on my money, right? If I'm looking at GBP USD, where both of the economies are sitting in positive interest rates, but one of them is higher than the other, then obviously I'm going to go park my money wherever the higher interest rates are, right? And this is heavily influenced by inflation, and it's also the most important factor in determining a country's currency value. So higher interest rates obviously means that money is becoming more expensive for the consumers, for the economy, but for investors, it becomes a lot more attractive. So if you were going into a bank and you want to open up an account, would you be going where they tell you that, okay, we're going to give you this much interest on your savings account. We're going to give you 0.02% versus a 0.04%. For a lot of us, being in the market, you're going to be like, that's not a lot. You probably have enough financial literacy at this point to be like, I'm probably going to go to a higher, a high yield savings account, or I'm going to go park my money somewhere else. But for a lot of people who don't have that enough financial literacy exposure, or they're not part of the market, these two numbers are going to be significant for them, 0.02 or 0.04. And they're going to go with obviously the 0.04, even if you're getting 0.2%, 0.02%, right? So those, basically think of that example at a broader perspective when it comes to the Forex market. Everything is going to be at a macro perspective for that. That makes sense. Any questions about that? Awesome. And then you have monetary policies, right? So we see the FOMC statements coming out. We have, even same thing for Bank of England, same thing for Bank of Japan, same thing for the European central banks. Through these monetary policies, that's how the central bank is controlling the money supply, the inflation. They're going to give you information about inflation and then reserve requirements and all that stuff. Any central bank has two mandates. It's price stability, which comes down to inflation. So they want to make sure that inflation isn't getting too out of hand, and it's also not too low, right? They always talk about that medium 2%, but hardly do the central banks ever hit that 2%. It's always a little bit above that, or it's always a little bit below that. Inflation is going to be the indication of the current account balance of a country. So if it's too high, then basically that means that, things are getting a lot more expensive. And then that's when, the central bank is going to step in and they're going to be like, okay, we're going to increase interest rates. Interest rates and inflation always have an inverse relationship in the sense that when inflation increases, the central bank is also going to increase the interest rates to decrease inflation, right? That's where the inverse part comes in. If inflation is too low, then or it's dropping down, and then you want inflation to increase depending on where you are in the economic cycle, then the central bank is going to step in and they're going to be like, okay, let's decrease the interest rate. So then that would increase the inflation. So that would basically mean the prices of these goods and products and those kind of things. Then you also have macroeconomics when it comes to employment, GDP, speeches, all those type of things. They're part of your macroeconomics. So you have different cycles in an economy. So the first one, let's say you were looking at expansionary, right? That's when I'm going in with $1.50 and I'm like, yeah, sure, I'll buy this product. And then obviously after a certain point as a business, you're going to think like, well, people are buying this product at $1.50. How about we hike up the prices to $2, right? Try and get more revenue. So you do that. So prices will naturally increase to $2 and you're still like, okay, sure, I'll buy that. Right. And then as a business, you're like, well, people are still buying. Yeah, the orders may have dropped a little bit, but it's not significant enough for me to drop my prices back down again. So you hike it up to $2.50. That is healthy inflation. That is an increase in prices that happens in more of an expansionary economic cycle. Then you hit the peak. The peak here would be the $2.50 or the $3, where you're like, okay, we're not really selling out as much, right? And we really cannot hike prices looking at the consumer behavior. That's your peak, your maximum employment. That's where majority of jobs are filled and everyone's pretty much happy. And then after a certain point, when you're getting back into that contractionary phase, that's when a lot of people are going to be more concerned about their jobs. They're going to be more concerned about I hear that there's layoffs happening. I hear that we're sitting at a max, like there's not a lot that's happening here. And then that's when you can see those prices dropping back down again. For example, the water bottle example, you're going to go from $2.50, you're going to go back down to the $2, right? And then you eventually go down to $1.50 and all that. And then at the very bottom is where you have the trough. That's where the fears of the recession, the hard landing, all that stuff kicks in. And then that's when decreasing interest rates, really promoting back into the expansionary phase of promoting businesses and consumers to go out and take loans and all that stuff kicks in. And then pushing right back up. So it's a continued cycle in that case. Any questions on the macroeconomics? All right, so then we have microeconomics next, which is the retail sales. When you go onto Forex Factory, you'll see a lot of this stuff too on a day-to-day basis. You have your retail sales, you have your manufacturing PMI, you have your services PMI, you have your home sales, business climate, consumer sentiment, all that type of stuff that kicks in, right? So this is microeconomics is telling you a health about different sectors within the economy. Macroeconomics is telling you the health of the economy. Microeconomics is sectors within that economy. And what we're doing here is we're understanding how different sectors within that economy are being affected right now, and how does that play into each other. Looking back at the flow, we went from consumer to retail to manufacturing to the rest of the economy, right? It's a repeating cycle like that. So here, when we're looking at the retail side, we're looking at the retail sector within the economy. When you're looking at manufacturing data, then you're looking at the manufacturing side of the economy. Home sales, you're looking at real estate, right? Business climate, you're looking at the consumers. So microeconomics is going to tell you the health of different sectors within that economy. Then you have geopolitics. You have wars, trade wars, or like actual wars like, Russia, Ukraine, Middle East, elections, unstable government. If there's natural disasters, pandemics, if there's political events, those kind of things, all of that will also impact your fundamentals of that specific pair. So for example, right now in the US, it's more of Trump's interference with the Fed's independence, right? That's creating some instability from a political perspective. If there's elections, right, for every country, you have two candidates. One of them is going to be a bit more conservative compared to the other one, or you're going to think about, if this person gets elected, how are their policies going to affect me as a consumer? How is it going to affect my business? How is it going to affect our economy? How is it going to affect our relationship with other countries, right? So you're making decisions based off of that. If you think that someone who gets elected It's not very favorable policies for me as a consumer. It's not very favorable for, whatever tax bracket that you're in, for example, or whatever, trade partners that you have. If you don't think it's favorable, then obviously you're going to be making decisions based off of that, versus if you think that, whoever is more favorable for the economy, more favorable for you, more favorable for our trade partners, you're going to be making different decisions based off of that, because you think that this person can really help the economy, versus the first one, you're like, this guy's going to just drown the entire economy, right? So you're going to be making different decisions based off of those. Going into interest rates. In short, if inflation increases, we can expect that price will show weakness. We can look for sells. So inflation, again, coming back to the economic cycle example that I was telling you, all of that, inflation is not necessarily bad and it's not necessarily good. It's all dependent on where you are within that economy. In expansionary, if inflation is increasing, then that is good, right? Going from 150 to 250. If it's in contraction, like right now, there's a lot of fears around recessions. There's a lot of that, that type of stuff. If inflation increases right now, then no, it's not good, right? So all of that is very subjective to where you are within that economic cycle. Does that answer your question? Yeah, perfect. All right, so going a little bit deeper into interest rates and monetary policies, we're not going to go through every single economic data point, but I do want you guys to have enough information so that when you step away from today's boot camp, and then when you have interest rates coming out, for example, in September for the Fed, that's what a lot of the market is looking for. You have Bank of England, you have Bank of Japan, you have ECB, you have all these central banks who are coming out with interest rates. At least you're able to understand, like, okay, what does this exactly mean? Right. So again, very subjective. Increase of interest rates is not always bad, and decrease of interest rates is not always good. It's really subjective to where you are within that economic cycle. But nonetheless, it is the most important factor in determining a country's currency value. As we talked about, think about as investors, like what you would be doing if you were presented with two currencies with two different interest rates. Where would you be parking your money? Most likely it would be the higher interest rates. This is the biggest influencer of interest rates, like we talked about, is inflation. If there's too much inflation, then the central bank will increase interest rates to bring inflation down. Now, when you increase the interest rates, you're basically making money more expensive. So if I increase interest rates to 4%, you are most likely not going to go out and purchase a house, or you're not going to increase, or you're not going to purchase a car or something like that, right? Versus if interest rates were 2%, then you're like, yeah, I'm more willing to go do that, right? I'm willing to pay 2% interest on whatever loan that I'm taking out. If there's too little inflation, then the interest, or the central bank, is going to decrease the interest rates. So then you're increasing inflation, again, making money cheaper by decreasing interest rates and really promoting people to go out and take loans and promoting economic activity happening. This will dictate the capital inflow and outflow of a country for that reason. How many investors are coming in versus how many investors are looking for alternatives. The big question here is, where are the interest rates expected to go? So whenever interest rate news comes out, it's not necessarily a reaction to, well, we increase interest rates, right? Right now, for example, a lot of the movement in equities in the US dollar, all that stuff is coming in because we're expecting that the interest rates are going to drop back down. When we're looking at that positive movement, right when Powell came out at the Jackson Hole Symposium, and he really laid the table out for September rate cuts, we saw a massive push when it came to the US 30, right? And then we saw a lot more movement. We saw a lot more volatility. That was because he didn't say necessarily we are cutting rates. He just opened the door for it. He didn't shut it out. He didn't say like, that's not on the table, right? That is the fundamental that set up the market sentiment of the market pricing in that 70% that yes, we're going to cut interest rates, 80%, yes, we're going to cut interest rates, 90%, yeah, we're going to cut interest rates, right? Those are the market sentiment that are setting up our decisions as traders and investors, and us thinking, where are the interest rates expected to go, right? That's where that came from. So then you have the contractionary versus expansionary monetary policies. Contractionary, again, being like, we're going to increase interest rates, and then we're also selling securities, taking money out from the economy, right? And then you're going to see them like decreasing their balance sheet and all that stuff. Expansionary is going to be more like, we're buying the securities back, in exchange we're giving the money for those securities within the economy. When I say that, I mean like from the banks, or like whatever other bonds and all this other stuff that we always read in the statements. That's what that means. We're going to decrease interest rates. We're going to make money cheaper. We're going to put more liquidity, more money within the economy. The monetary policy purpose, again, control money supply. That's how you're going to do it. Inflation, reserve requirements, etc. Those kind of things. Then you have economic reports. This is more of your macroeconomics data that we're talking about. Your NFP, that tells you about employment. CPI, that tells you about inflation. PMI data, that's the Purchasing Managers Index. So manufacturing or the services side, it's going to give you information on that. Unemployment claims, again, employment, housing starts, business climate, etc. So the way that you trade this is, again, we're looking at the previous, the forecast, and the actual. The sentiment leading to the anticipation of the release. So then you have looking at the previous versus what are we expecting, right? That's your sentiment. You're trading based off of that. And then you have the sentiment at the release. So maybe we beat the expectations, maybe we're below the expectations and even the previous. Sometimes we're at the same exact level as the previous, but we're expecting an increase or decrease. What's the sentiment at that time? How's the market pricing that in? And then that's why a lot of people say trade after the news comes out, so 15 minutes after. So then you have the full picture. You have the previous forecast and the actual, right? And then you're looking at pretty much the actual versus the previous. Did we beat the previous, or were we below the previous, or were we at the exact same level as the previous, right? The ability to factor in the data release into the overall economy. That's what we're understanding, the overall picture of it. What does this mean? If inflation beats the previous, obviously that's not a good thing right now, right? If consumer confidence beats the previous, that's a good thing. That means that consumers think that there's going to be a healthier outlook for the economy. If it's below the previous, then obviously it's not a good thing, right? You're going to see a drop happening for that specific currency. And then you're going to pair an anticipated weaker currency with an anticipated stronger currency. So GBP, JPY, for example, taking buys and sells based off of that type of data that's coming out from the UK versus from Japan. So quick little knowledge check before we move on to soft FX here again. So what is fundamental analysis? I want you guys to drop that into the chat, what you think your answer is. So what is fundamental analysis? Is it the driver that markets through economic, social, and political news? Is it the understanding of market sentiment and technical analysis? Is it the overall attitude of investors toward a particular asset? Or is it using patterns in the history of an asset to predict future price movements? So A, B, or C, D? All right, we're getting a lot of A's. Awesome. Give me 1 second. All right, we're going to have blueberry people joining in pretty soon. Perfect. It is A. Awesome. Next one. What is the most important factor in determining a currency's value? Is it interest rates? Is it monetary policies? Or is it economic reports? A. Okay. What else? Awesome. It is A. I'm going to take this one step further. I want someone to explain to me why is it the most important factor in determining a currency's value. So if you were to explain interest rates back to me, you know, how would you explain it? Or someone else, whoever's in the chat, if you had to explain that to someone else who is a beginner, why are interest rates so important? Dictate inflow and outflow of capital in country, determines the price to borrow in the currency, interest rate influence the strength of a country's currencies. All right, if I was a complete beginner and I was like, I don't even know what that means. If you had to give me an example, how would you explain that to me? And feel free to unmute and say it as well. You guys all have it down. That's 100%, right? It's just a matter of just giving me an example. So there's no right or wrong answer here. It's just an example that you're giving me. High inflation equals increase in interest rate and vice versa. It's more valuable, so it's more expensive to borrow. I think low interest rates is good. Again, that comes down to being subjective of whether you're sitting in a healthy economy or you're sitting in a contractionary economy. If you increase or you decrease interest rates, low interest rates could be bad because then you're promoting increase in inflation. And sometimes you want the inflation in a healthy economy, but sometimes you don't want that when you're sitting in recession fears and things like that. Makes money more or less expensive depending on the situation. Yeah. Interest rates affect both the consumers and the producers. Yep. Pretty good, you guys. Actually, before we hop off or hop onto soft Forex, I think let's get through the market sentiment and psychology aspect, because then when we go on to soft Forex and we're taking the trades, I think we will be able to piece everything together. All right, so the key points here about fundamentals, I think all you guys did great, pretty good understanding, just as long as you understand the baseline of why interest rates are important and what do they mean for the economy. Key points about fundamentals, they're the driver of the markets. It's going to shape our sentiment. It's going to shape the type of decisions that we will be making. And that's true of not just Forex, but also, if you're trading stocks, right? Or if you're trading options, if you're trading, or if you're going out and you're making an investment, you're buying a house, you're buying a car, you're buying a business, whatever, right? Fundamentals, looking at the state of the economy, is going to influence your decision of whether or not you're making that investment. It affects the supply and demand of an asset, right? The better a country's economy, the more investors and businesses the country will get. So that brings in more capital inflow, and it affects the strength of the currency in return of that. But the main thing to understand here is that just because NFP came out, just because CPI came out, the market is not moved by just one economic data report. It comes back to understanding the ability to factor in the data release into the overall economy. What does the CPI release mean? What does the NFP release mean? What does it mean for the current economy? Again, coming back to understanding the economic cycles, and when is inflation good in expansionary? When is inflation bad in contractionary? When is high interest rates good, right? When is low interest rates good? Those kind of things. Let's hop into market sentiment and psychology real quick, so then we can apply that onto soft Forex, and then we should have Blueberry hopping in pretty soon too. So market sentiment, pretty much all about emotions. It's the easiest way to put it. That is basically, I saw news, I saw economic data, I see what's happening in my current economy, and then how do I feel about that? Because that's going to influence how I make my decisions. So this is how institution traders is, fancy word of basically saying like the banks, hedge funds, those kind of people. Investors and retail traders like ourselves, how do we feel? And that's going to determine, again, it's going to be expressed through the positions that we're going to take in the market. That's going to determine the type of trades and investments that we will be making. Market moves according to the collective sentiment of the market participants. So just because VJ feels that the economy is weak and she's looking for a sell, or just because Tony feels that way, or just because Yanette feels that way, or just because Brian feels that way, or just because Vinayak feels that way, that individually is not going to move the market, right? It's a collective sentiment. So again, looking at consolidation from a technical perspective, all of that is a market consolidating orders. Consolidating, are we going to get more buyers or are we going to get more sellers, right? So it's not going to move just based off of one person's sentiment, based off of one bank's sentiment, based off of one hedge fund. It's a collective sentiment. What do we think overall of where is price headed? Where is the economy headed? You pair that up with your technical analysis, you pair that up with your fundamental analysis, and now you have additional confirmation of the trend. Where is price headed for longer term or short term, right? And that's where you understand where the limitation of your trades is. For example, when we took, GBP, JPY, we took that quick sell. We knew the sentiment in that time frame, in that short time frame, was seller's pressure. That's when the sellers were going to kick in, because from a healthy bullish structure, we had already created a new high and we were tapping into a weekly and daily resistance. So there was going to be a corrective move. Now it's a matter of how long can that continue. Obviously, we took our 1-to-1 as an example, but you guys saw how price pushed even deeper than that, right? So that was basically the market saying like, no, there was a massive push up and we can correct a bit more. And then we saw that consolidation, and then we saw price pushing after that, right? Exactly. The market doesn't care about your feelings, right? And then same thing, if you're looking for, buying opportunities after a sell, understanding what's the limitation of your trade there. Does it follow the overall trend? And is it going to keep pushing? And are the fundamentals there to continue feeding into the sentiment of that bullish momentum to the upside? So fundamentals, which create your market sentiment, which then you see as a visual representation on the technical side. So market sentiment is formed by, fundamental analysis plus technical analysis. This one's a little bit switched, but it's pretty much the same thing, right? The traders, investors, institutions, they will form their sentiment based on the upcoming news. What are we expecting? So right now we're expecting the Fed will cut interest rates, right? So we're seeing a lot of the movements in the market based on that. What are the traders, investors, and institutions thinking is going to happen, and what does it mean for the economy? And then they adjust their trades according to what they anticipate will happen. If we think, when you read articles, when you go into Bloomberg or you go into any other news outlet, I'm sure a lot of time you guys have seen it, and especially if you're watching my weekly outlooks on YouTube, you must have seen it there where I say that the market is pricing 70% chance of cutting interest rates or 80% chance of cutting interest rates. That's how they're adjusting their positions according to what they anticipate will happen. 70%, 80%, 90%, we're going to cut interest rates. What does that mean for the economy? What does it mean for this particular asset? Am I buying that? Am I selling that? What does it mean? How does it fit into the bigger picture, right? And then when that cuts down or that percentage drops even lower, and then we're sitting at like 25% of like, yeah, there might be a rate cut. That's very low. That's basically the market saying like, I don't think we're going to get a rate cut because of the economic data that came out, right? So they're going to adjust their positions according to that. So most important news is the high impact news, which is going to be the red folders. And that relates to changes in interest rates, inflation, and the economic growth. So like GDP, advanced GDP, prelim GDP, all that type of stuff. It's also the most volatile and the most traded, the red folders. That's where you're going to see massive wick rejections on lower time frames. That's where you see, a huge inflow or outflow, depending on whatever pair that you're trading and the news that's about to come out for your pair, about 30 minutes, an hour. And then as you're getting closer to the actual release, you start to see the volume dying down a little bit, sitting into consolidation, and then you see a massive push right when the news comes out. All right, so now let's go ahead and hop over to Soft Forex, and then we should have Blueberry joining us very soon. Let's take a quick 5-minute break before this. Everyone good with that? Refill your water bottles, review your notes, anything. All right, let's check out news. All right, we have interest rates coming out soon. So let's go ahead and skip over to interest rates. We'll remove everything from the charts and we'll redo our top-down analysis. I like to redo my levels every day that I come onto the charts because of the new development that already has happened in the markets, obviously. So let's skip over to actual BOJ. Let's do about an hour before. All right, that's an hour before interest rates are going to come out. We're expecting that the interest rates are going to be maintained at 0.5%. So let's go ahead and remove everything from the charts. All right, awesome. So top-down analysis, I'm going to have you guys annotate once again and tell me, first of all, what structure do you guys see here? Is it bullish, bearish, transitioning into another structure? What do you guys see happening here? Yeah, of course. Go ahead, unmute.
Hey, Sharma. I wanted to ask why basic economics, demand and supply, the law of demand and supply, and access demand and access to supply doesn't work on the chart.
Sorry, excess demand and supply, why doesn't it work on the charts?
Yes, I did economics. I thought it was going to be easy for me because I mastered those theories. So now when I come to the chart, I see a whole different thing.
Yeah, it's understanding, again, subjectively, where are you sitting, right? For that pair, for that currency. it comes back down always to that economic cycle. That was a main thing for me as well. Studying economics and trying to apply that onto the charts. It's understanding from every different time frame and higher time frame, lower time frame. It's all going to be something different. Just give me a quick second, and then I'll have you guys annotate as well. So breathe. And so applying that, it does work. It's just understanding the bigger picture. You are in Forex. It is the biggest financial market. Everything's traded into this market. So really understanding the bigger picture and then narrowing it down. So in economics, we're always taught, think about the bigger picture, think about long-term. What does it mean for the future? What does it mean for that? What does it mean for this? But then also being able to apply the same exact concepts onto a lower time frame and understanding where you're sitting right now. And then based off of your, trading style, I don't know if you're scalping, I don't know if you day trade, swing trade, whatever it may be, but being able to adapt to that same exact. So like if you're scalping, then lower time frames, being able to adapt that information to a lower time frame. If I'm scalping, I'm not thinking about what's going to happen in 3 months, right? I'm thinking about what's going to happen in the next few hours, what's going to happen in the next few minutes. If I'm swing trading, I'm thinking about what's going to happen within the week. If I'm like looking for a longer term position, then yeah, I'm thinking about what's going to happen in in a month or something like that. So it's just a little bit of adaptation.
Thank you.
Yeah, absolutely. All right. I did see a lot of you guys were eager to already annotate. So tell me, what is the current resistance? What's the current support? What kind of structure are you guys seeing here? So we're focusing on this here right now. All right, we got that resistance right up top here. Top wick. That's what we're rejecting right now. After that, then we can head up. What about support? Perfect. Yep. You guys are doing good. Awesome. Now let's go ahead and drop down to the weekly. So this is our range at the moment. If price breaks above that, then we can target some of the higher time frames. If not, then again, we're looking for a trade within this range here. Now coming onto the daily time frame, is there any other level that you guys would like to mark off? Is there anything else that stands out to you guys here? All the way down there, okay, but we're looking within the range, right? So think about that box. So before we're headed all the way up top there or down here, we're looking within our range. All right, why, whoever made this green line, why that?
It's the previous candles law.
The current candles, yep. So what does that mean? Why is that important?
That's the lowest point of the day.
Lowest point of the day, perfect. So before we're headed there, is there anything else here that you guys would like to mark off? Is there any other level that we should be watching out for? Yeah, there we go. So here I'm going to create a zone instead of a line. So we can adjust this when we drop down to lower time frames. Basically, I want to see what's happening here. We got a lot of rejections here. We got a lot of wicks into this area. That's pretty much the level where this current daily candle flipped and then continued pushing back up bullish. So I want to see if, obviously, if we break below that, then we're headed down to the current daily low and then the support here as well. So I want to see what happens here if we've already established a support, if we're seeing a continued push up. If we have not established a support here and price just continues creating a new high as it has right here, then we're looking for sales to come back down to support. It's very important that these major levels, especially based off of weekly, daily, 4-hour, are always respected as new resistance or support levels. All right, now coming on to the 4-hour. We see those rejections into this area. I see a push up. There was a bit of a break and retest, but we have not established this area here as a support just yet. So either I can keep this level or I can adjust this and bring it a little bit higher, because now what I'm saying is price needs to break below this before it can head back down, further down. And that's the previous, or this the current support and break and retest support that's forming at the moment. So you can do that. You can adjust your levels or you can create a new level. I'm going to just from a visual perspective, not to overwhelm anyone or anything like that, we're gonna keep it at this level here. All right, now we come on to the hourly, and we see that at every point, price is creating new highs, push back up, held onto a support, push back up here again, and we're rejecting into that weekly resistance and the daily resistance right here too. So nothing else to mark off here just yet. You got the 30, you've got the 15, and then again, this is about an hour before BOJ interest rates come out. So let's go ahead and play this, and I want you guys to see how the market starts reacting. All right, we had a question here. Hi, Sharma. Are all analysis is relative to the current or most recent pricing correct? Yeah, so that's pretty much depending on what style of trading that you have. If you have scalping, day trading, you want to look at what is it like relative to the most current pricing. What does price need to break right now before it heads up to the next level? If that's what pretty much your question was, I hope that answered it. Perfect. Got a little bit of slowdown in the volume. Excuse me. All right, let's go ahead and skip through. Let's skip on the 15. I'm going to have this up too, so news comes out in about 44 minutes. Now, this is Asian session. I should also mention that. This is currently Asian session with BOJ interest rates. So that's where you're going to see a lot more consolidation. You're going to see a lot more slower movements. That's what Asian session is known for. All right, you got about 15 minutes. What I want you guys to really pay attention to is, and I can speed this up a little bit, is how the market starts preparing and how it starts moving 10 minutes before news comes out. So I want you to see the difference 10 minutes before, 15 to 10 minutes before news comes out, and then the volume after the news comes out. This is obviously high impact. Look at this movement based off what anticipation about 8 minutes before news comes out. Another important thing here, whenever you're trading interest rates, is always listen to the press conference and what they have to say there. The monetary policy statement is going to tell you the current, right? The press conference is going to give you the forward guidance, and that's what the investors want. That's what the traders want. They want to see what the forward guidance is. What that basically means is, what can we expect going forward? And again, that's going to frame your sentiment. That's going to frame the type of trades that you'll be looking for. For short term, looking for a quick scalp, just looking at the policy rate and then looking at the monetary policy statement could work. But if you're someone who wants to practice holding out your scalp to a day trade or to a swing trade, you should start looking into, the forward guidance and how to understand that. And within this, also look at the technical structure. So here, for example, we're pushing up In 2 minutes, we have news. The key thing here to see is if we're going to break these previous highs. It seems like price has maintained a minor resistance right here. As long as we don't break that, and price has already broken the previous lows, you're good for those sells if you're looking for sells. Once price breaks above that, then you're looking for buying opportunities to the upside. That is a mini consolidation formation right here. All right, so now news has come out. We're holding out the interest rates at 0.5%. You got the monetary policy statement, and then in about 2 hours, you're going to get the press conference. So what we're looking for here is the previous candle made a top wick, and then it also had a bottom wick, closed bullish. The current one, you're seeing that volatility kick in, right? It's breaking the previous lows. So here, either you can look for a sell, and you place your stop loss right above this level, or you give it about 15 minutes or so after news has come out. You wait to see how this candle has closed. If it closes bullish and then it continues pushing the next candle, you're looking for your buys. If this one closes bearish and then the next candle continues pushing down, then you know you have your sells to at least come down here. Welcome in, Tim. Tim is from Blueberry Markets, you guys, so he's going to be helping us out with answering any other questions that you guys have. We had a few questions in the form, so we will make sure to address those first. And then if you guys have any other questions, you can put that into the chat for him.
Great to see everyone learning so much. I'm really looking forward to getting to know, hopefully, a lot of you as well.
Sharma, going back to the this particular trade, did you mention 15 minutes after the news comes out and the candle closes? That's when we decide whether we're going to take a short or a long.
Yeah, as a confirmation. So right now, the market's reacting to obviously the news release, the statements, reading through the statements. So after the 15 minutes is when the 15 minutes when the news comes out, you see a lot of volatility, right? We saw top wick, bottom wick. After 15 minutes, I'm looking for a continued trade after that. So then that's the trade, that's the candle that I can take an entry on.
Cool, got you. Thank you.
Yeah, absolutely. This won't take too long, Tim.
No problem at all. No problem at all. That's completely fine. As I said, I'm really looking forward to this, and it looks like you've already gone over quite a lot of information. So I'm sure everyone is penciling away, writing everything down.
Absolutely. We weren't going to record this initially, and then we got a few questions. I was like, you know what, why not? I knew it was going to be a ton of information anyways.
I love it. I think it gives people the ability to go back over things that you've gone through as well. So no, I think recording is an awesome idea.
Awesome. All right, we got 2 more minutes, less than 2 minutes until this candle closes. Obviously, we got a lot of bearish volume. All we're going to look for, if we're looking for sells here, is a bearish candle closure and then a continued push down. If this candle flips back up and closes bullish, then we're not necessarily looking into sells, but our first target is going to be somewhere down here if we do end up looking for sells here. So we got a bit of a doji, but still a bearish candle. So here, even from here, from a technical perspective, breaking previous lows, not really breaking previous highs. So as long as it makes the top wick and it clears below these areas, these wicks, you got a pretty good sell opportunity. Place your stop loss up there. Target, again, as a beginner, 1-to-1. So we're pushing a little bit more. So see, we're clearing below those areas. So here, what I'm doing by waiting is testing the volume. When it breaks its own low, I know there's more seller's pressure that's kicking in, and that's an opportunity that I can take. Sometimes what price will do is make its own bottom wick, but then it doesn't have enough bearish volume to keep pushing. So it kind of just ranges there, it closes like a doji, or end up consolidating, right? So that's one way that you can test the volume in the market. What I'm going to do is go for a 1-to-1. So I'm going to place my stop loss right above the previous candle top wicks right here. If you want, you can do it right into the zone. You can do an exact 1-to-1, whatever your preference is. This is pretty much what we're going to go with, right? Risk to reward, 1-to-1. And then you have press conference about 2 hours. So there's really nothing else but just the market reacting. So this is the unrealized profit loss I was showing you guys initially. This is with my current trade right now. See, it's above my entry price. So that's my unrealized. So I haven't closed this out just yet. And this is going to adjust because this is my realized profit loss for my previous trade. So this is going to obviously do the math here, and then it'll give you the total profit loss that it's floating in at the moment. So some of realized and unrealized profit loss. Is all this making sense? Any questions, any confusion? Did I lose anyone at any given point? All good? Awesome. So even here, see the candles pushing. So at this point, normally, if I was talking about, increasing your TP, I would be saying something like, if price breaks below this low, gives me enough volume, can break its own bottom low, I would increase the TP. But as beginners, start with that 1-to-1, get comfortable with just taking trades, just executing, just placing your stop loss for your TP, understanding limitations of your trade. Just get comfortable with the market as a beginner, and then start to increase your TP. And then this one is going to tell you this tab here, market and pending. So right now we're floating in about, almost $50, $60 in profit. You can do in pips. So it'll tell you how many pips as well. So here, clearly you see it's not a lot, right? So 2% of that $5,000 account is 92 cents. So you can do the same thing. Obviously, your profit and your losses would be kind of smaller if you started off with a $500 account or a $1,000 account. The point is that your technical setup, your fundamental analysis, your market sentiment analysis needs to be strong. That foundation needs to be strong. And then regardless of whatever account size that you're trading, if you have that down, then you can trade on pretty much any account size that you want. Of course, it does mean that if you start off with a smaller account, the growth or how fast you're going to be growing is going to be a little bit slower compared to a $5,000 account or a $10,000 account. But the point here is really understanding the markets, what's happening in the markets, so then you're able to use that information, that foundational information, that knowledge, that education, and then expand it out to being able to trade, instead of just currencies, maybe even indices, US 30, being able to trade gold or anything else, right? This is very foundational knowledge that you're able to use even outside of the markets. So really understand, what's happening in the markets, how things are moving, how the currencies are moving, what the sentiment is like, risk on versus risk off, all that type of stuff. So this is very important. And smaller account is going to make you focus on these things because you won't be able to grow so fast compared to a $10,000 account. That, I think, is another mistake that a lot of people make from a psychological perspective. Initially, it seems nice. Yes, I have a $10,000 account. I have a $100,000 account, but you won't be getting used to, seeing the big losses or the big wins. Like, it's really going to mess with your entire trading psychology as well. So start small. So then you're focused, or you're forced to focus on taking the proper entries, placing your proper stop losses, getting comfortable with understanding what's the limitation of your trades, getting comfortable with when can I increase my TP versus this is the lowest that I think price is going to go in terms of a sell, or this is the highest that I think price is going to go. So really making you focus more on your risk management, which is the most important part in trading, right? Really preserving your capital and then growing it out. Any investment, that's what that basically would mean. All right, so we got our TP hit. So far between these two trades, we're up about 4.32% on our account. That's why I love using percentages when I'm trading as well, instead of saying like I'm up, $40, $100, $20, whatever. All of that sounds great. It's amazing. But when you start focusing it on from a percentage perspective, whether it's a $500 account, $5,000 account, it's going to be a lot better for your own trading psychology as well. Versus if you look at a loss on a $500 account, $20 loss might not seem that bad. But on a $10,000 account or a $20,000 account or a $100,000 account, the losses are going to be much bigger, and that tends to have a much bigger impact or much bigger impact on people's trading psychology, right? And then you're like second guessing. Now you're hopping strategy to strategy. You're going through this entire cycle, which you know that you shouldn't be doing, but you do it anyways in terms of thinking of, I want to make back this loss, or you're just moving in this cycle of anger, frustration, over trading, over risking, and you get into that entire cycle. So think of it as percentages, because a 4%, again, it's not going to seem a lot on a $500 account, but if you can do a 4% on a $10,000 account or bigger, obviously your profits are going to be much bigger there too. So with that being said, I'm going to go ahead and pass it over to Tim. Go ahead, Tim, all yours.
Wonderful. Thank you so much. And yeah, again, thanks everybody for joining. I think there's a wealth of knowledge coming from here. And I think if you can utilize even part of that, success is just around the corner. But yeah, look, obviously I wanted to jump on today. Obviously, we've developed a relationship and a partnership, and I think with that will come some questions and some I suppose some points that we wanted to touch on. Obviously, Blueberry wants to be or is the recommended broker, meaning you can put into action what Sharma and SharmaFX, I should say, is obviously teaching. And I think that provides great benefit. I think, Blueberry is a fully regulated broker, but we're also very transparent. The reason I say that, not all brokers these days are super transparent, which horses for courses, they can run their business how they like. But what we obviously did or wanted to do when we set up Blueberry all those years ago was to ensure that we are adding value to traders and also obviously to anyone who's looking to learn how to trade as well. So just to give you a little bit of background about myself and Blueberry. So Blueberry was founded in 2016. Funnily enough, it was one of my childhood friends who founded Blueberry. So I've known him since we were 7 years old. We've had fights, we've had a lot of love, but at the end of the day, we're working together to bring, as I said, a really transparent offering to any trader, regardless of where you are. Since those early days, it was me and Dean sitting in an office which wouldn't have been much bigger than most people's closets. And now we're running with multiple offices in multiple regions, obviously hold multiple financial licenses, and the growth that we've experienced is something we're very proud of, and we're hoping that we're going to continue that growth moving forward. Me, myself, I started in the industry 10 years ago. I worked for another competitive broker. But as I said, when Dean had founded Blueberry, he did ask if I wanted to join and take it by the scruff of the neck and really make a good go of it. So look, one of the better decisions I've made in my life was doing that. I've made plenty of poor ones, but I think working with Blueberry is what I can honestly say has been the better decision I've made in my time. What I'm focusing on is I'm located in Vanuatu, so I'm the director here. The reason why we're in Vanuatu is because we have the financial services license here. We do also hold one in Australia through ASIC. We have in the SVG, so St. Vincent's. We've got one in Mauritius. We're pending having one in Dubai, Malaysia, and we're working on Europe as well. But Blueberry, as I said, is fully regulated. And obviously we want to put forward our best foot, and that's being open with traders. And then that way we can obviously add that value by providing those good trading conditions as well. Ivan, I saw that there's a question there as to whether we accept US clients. Unfortunately not. And I'm going to touch on that. I've got a few questions that have been posed, which I wanted to obviously run through and to give you a bit of an understanding as to where Blueberry is and obviously where that will work for you as well. So I suppose the first question, are you happy for me to start going through those questions now? Cool.
Yeah, let's go ahead.
Awesome. Lovely. So the first question was, why is leverage different depending on the region and country, and does that impact traders with smaller accounts? So yeah, look, leverage is different depending on which license a trader is under. So, for example, in Australia under ASIC, there's a restriction on 1 to 30 leverage. It's the same in Europe, where a lot of brokers are under ESMA and the FCA, which again is at 1 to 20 or 1 to 30. So one of the benefits to Blueberry having the financial license here in Vanuatu, as well as other regions, is that we are able to offer the higher leverage up to 1 to 500. Now, 1 to 500 leverage isn't for every trader. It's, in my opinion, it's for people who know how to manage leverage products. So look, the standard in my opinion would be to be trading on 1 to 100 leverage, maybe 1 to 200, until you're fully understanding how the trading works and how the leverage affects your positions. You know, for the smaller accounts, the lower leverage means you need more capital to take those same position sizes. So it forces traders to manage risk a little bit more carefully, but it can also make it slightly more difficult to grow those accounts, you know, as quickly. So I think with the leverage side of things, yeah, the different regions just depend on the license in which people are under. And that's why brokers like ourselves have licenses in these regions, which still offer the 1 to 500 or up to 1 to 500. Back when I started, every broker was able to offer it, which is wonderful. But I think obviously that has changed quite a bit over the years. There are brokers out there who will be offering, you know, 1 to 1,000 leverage. I think I've even seen 1 to 5,000 leverage, which sounds wonderful. But putting it into practice and using 1 to 5,000 or 1 to 1,000 leverage, the risk is enormous. So again, you just got to be careful with leverages and how you manage your positions as well. For the next question, it was during major events like CPI, NFP, or rates. How much do spreads realistically widen and why, I should say. Look, the thing about the spreads during those high impact events is that in reality, there is no ceiling. You know, theoretically, it could be 1,000 pip spread. Now, in my 10 years of trading, I obviously haven't seen that, but there are instances where you can get 20 pip spreads for a period of time. So when the euro was the Swiss franc issues many years ago, that's one of the instances where those spreads did widen to that level. But if you are looking at, you know, CPI or NFP or rate announcements, you're probably going to be looking at spreads around 5, 6, 10 pips. And again, that's just for a short period of time. And that's, you know, a few minutes up to 10 to 20 minutes after those kind of announcements. Obviously, exotic pairs, it could be much more. So if you're trading USR, you're not going to get even a 20 pip spread. You're probably looking towards 1 or 200 or even 300, 500 pips as well. As far as the spreads are concerned, it's not Blueberry, nor is it the broker as such widening the spreads, synthetically widening the spreads. It is what the market is dictating. So if you were to look at any broker over that time, what you're going to see is that those spreads are going to widen considerably. And the reason for it is because of the liquidity providers. So in trading, it's all about buyers and sellers in the market. The people who move the market the most are institutions and banks and prime brokers. So what essentially happens there is because of that volatility, you're going to find the spreads. So you're going to find people, those larger institutions, removing themselves and removing that risk. So what that's essentially going to do is that funnels down through to you and I, to a retail trader, and it is part and parcel. So volatility can be wonderful. Depends on how it affects you, right? So if you have a really volatile market, then there is going to be those wide and fast movements, which is good, obviously, if you're on the right side of that. So look, with anything in life, there's risk. So you've got to do your risk analysis and say, look, am I willing to trade over these high impact news events and trade these volatile markets? If yes, then you do also have to be prepared for that to go the other way really quick before you blink your eyes. So yeah, all in all, the widening of the spreads, again, there is no maximum as such, but you would be you would be best served treading cautiously over any news announcements, just because you are going to find yourself with wide spreads on occasion and also slippage as well. So I hope that covers that question sufficiently. The next question was, how do you handle slippage? And is it possible for traders to receive positive slippage, or does it always work against us? So slippage can go both ways. The problem with slippage from the retail or a trader is concerned is we only remember and we only think about the negative slippage. So if you get positively slipped, a lot of people don't even notice it. But when you do have a losing trade, as all traders should, is they analyze what's happened and then they see that they may have been negatively slipped. So yeah, look, the bottom line of that is that it does go both ways. Slippage essentially happens just when your order is filled at the next available price because the market has moved. So we've all seen how quickly the FX market does move. By the time you click, you're talking milliseconds, and depending on the volume in which you're trading, a couple of milliseconds could be the difference between $10 difference and $1,000 difference. So the more volume that you are going to be trading, obviously that's going to amplify everything. And with slippage, that's the same thing. So yeah, again, slippage can happen in both ways. If you do obviously experience slippage, whether you trade with Berry or another broker, always welcomed to reach out and say, can you please take a look at this trade and give me some data to support this? Obviously, we would be stretched thin if everyone did that with every single trade. So I think there's an element of people to understand that slippage does happen. But yeah, there are instances there where it is maybe outside the norm. We're more than happy to pass on any sort of data, and any sort of tick data is what it's called, for every price that we've received from our liquidity provider. Okay. The next question was, there's a myth that brokers make most of their money from losing traders. How true is this, and how does Blueberry actually make money? So that's a really good question. So look, Blueberry operates on an ECN or an SCP model, but we do have a hybrid model. So the way it works is brokers make 90% of their money through spreads, commissions, and any other sort of fees like swap-free fees, etc. With Blueberry, no, we don't make money from losing traders. In saying that, we may be the counterparty to your trade. But what happens is, as a trader, you're always going to have a counterparty. So the way that we decide as to whether trades go through to the open market or not is predominantly based on what the cost would be for us. And what I mean by that is, we may internalize some flow. So if people are trading micro lots, it's going to cost us more money to send it through to an open market than what it would for us to just internalize that flow. So yeah, we are operating and Blueberry's not out to do anything untoward at all. The prices are the prices that we receive from liquidity providers, and with that means that you are going to find yourself getting best execution possible as well. With the next question, many retailers believe brokers hunt stops or manipulate price. How can you prove that execution is fair? So we don't create our own prices. The quotes do come through the top tier LPs or prime brokers. They're aggregated and then they're passed through. So what happens is we will get our liquidity from a handful of, as I said, liquidity providers. So that might be Deutsche Bank, that might be Barclays, it might be other institutions as well. What we essentially do is we get the best bid and the best ask price and put them through to the platform. That's the way that all brokers will work. And that's how you get those prices, 24/5 or 24/7, depending on the products in which you're trading. The stop levels are triggered when the market price reaches them, not because, we push them there, so to speak. But what I suggest people to do at any time is to always compare spreads and execution between brokers. I think at the end of the day, there is, unlike, you know, a share or a stock price, there is no definitive price, because everyone's getting different prices from different LPs. So they will be slightly different. You know, if you look at Blueberry, we might have a Euro USD spread of 0.1 of a pip. And if you look at a US broker, you might be looking at 3 pips. And the reason why I say that is because, yeah, the broker essentially needs to develop those relationships with liquidity providers and get the best price. From our perspective, or broker's perspective, I should say, the more volume that's traded, the better deal that we're able to get ourselves. So if we can send through X amount of volume, like anything in life, the more you buy, you go to the grocery store and you buy 100 gallons of milk, they're probably going to give you a slight reduction in that cost per piece. It's the same with trading. So if we can send through, you know, large amounts of trading volume, then we're going to start to get ourselves a cheaper rate, and then that's obviously passed through to the retail traders as well. Hunt stocks, it's not really a thing, to be honest with you. The way, the kind of work, and I've thought about this for many years, and obviously had many discussions about it. The brokers work with tens of thousands, if not hundreds of thousands, if not millions of traders. So, you know, I know it's not necessarily so. No one's necessarily saying that there's a person devoted to each account to look at the account and watch their trade, because that's obviously physically not possible. But it's just not something that is done. Brokers don't hunt prices, unfortunately. With the market, it is, there's a lot of investors, there's a lot of traders, but a lot of people don't go into it with the kind of knowledge that perhaps they should. And I'm not suggesting that people need to be professional traders, but I think at the end of the day, you know, using education and using the understanding of the market is what's going to make it the most, I suppose, fair across the board. The next question was, who are your main liquidity providers and how do they impact execution quality for traders? So sorry, I almost touched on that in that last question. So yeah, we work with tier 1 banks and institutions and prime brokers. Again, we aggregate the best prices, so the best bid and the best ask price. The more liquidity providers we can have, obviously the tighter the spread, the deeper the liquidity, and the faster the execution, and the lower the spread or the cost for the end user. When we use multiple liquidity providers, obviously it reduces the potential of having requotes or failed orders during those volatile times. But yeah, as a broker, what we need to do is make sure that we have sufficient depth in market, and the way that we do that is by developing those relationships with multinationals and liquidity providers who also provide that liquidity to, you know, 95% of other brokers as well. Some traders can't open accounts because of country restrictions. Is Blueberry working on expanding access to more countries? Excuse me. Yes, most definitely. So there are a couple of restricted countries, namely the USA. That's really unfortunate because obviously a lot of brokers, including us, would like to be available there. It's a licensing issue, meaning that we would need to have a license or a physical presence in the US. And it's just not necessarily what we're looking to do right now. You know, ideally, in 5 years, we will have that ability. But other than that, yeah, we won't be able to work with US traders. We also can't work with a couple of other countries, which I can always provide a list of those countries to people. Obviously, that would be, you know, certain regions in perhaps the Middle East and other countries in which you know, trading or CFD online trading is banned. So yeah, if you ever need or want a list as to which countries can and can't, feel free to reach out. There's about 25 in total. But yeah, again, reach out if anyone wants to go through those or are concerned. The top 2, 3 mistakes you see retail traders making with their accounts, and how do you help them improve? Okay, so look, with trading, I think everybody undervalues the psychological aspect. I think with trading, you can have a really good strategy, but if you don't have a really good mindset going into your trading, it is going to make it very difficult. So a lot of the time that looks like over leveraging positions, mostly chasing one's tail. So what I mean by that is, people can go into a trade and put all of their parameters in place, their stop loss, their take profit, etc. But once you're in the trade, the psychological aspect is much different. And if it, for example, if your trade is getting close to your stop loss, people naturally don't want to be proved wrong. So with a stop loss, for example, you will start getting closer to a stop loss, and because as a human, it's not saying anyone's wrong, but as a human, we will move that stop loss a little bit further away because we want it to retrace and go back in our favor, and so we make money. It's a similar thing with take profit. Again, I hope people don't take this wrong, but humans can be naturally greedy. And what I mean by that is with a take profit, you can do all of your analysis, all of your setup, have your take profit at a level which, let's say, for example, would make you $100. It gets closer, it gets to $90, gets to $95. For some reason, the analysis that you've done goes out the window because you now want to make $120, $150. So you move that take profit again slightly further away. And a lot of the time, your analysis was correct. So it does hit your take profit, or what was your take profit. And then you pushed it that little bit further, the market goes against you. And now you're in a position where you've got to go back to the drawing board and try and make that money back. So I think, again, it's just, I suppose, believing in what your analysis told you. And I'm a big advocate. People can trade however they like, of course, but I'm a big advocate. If you are going to put on a trade, do your analysis, put your stop, your take profit, whatever it may be, place the trade and leave it. Maybe do a trailing stop if need be, or if you really wanted to. So obviously that can follow your TP, your take profit. But yeah, just understand that your analysis was done with a clear mind, not with emotion attached. So I think that's probably the biggest advice I could give, so to speak. And that's just an emotional reason. And I think maybe trying to trade too many different products is also because what will happen is if you try and trade every FX pair or 5 or 10, a bit of gold, a bit of crypto, a bit of oil, you're making it more convoluted. You want to become a master of a product or a pair, and then you want to start to explore other options available. Because I think I forget what the saying is off the top of my head, but it's a master of none. I can't remember the actual saying, but essentially, if you're
a master of all is a master of none.
Yes, exactly right. Thank you so much. And I think that's exactly what it is with trading. I think if you can sit there and really focus attention on gold or Euro USD and become a master of that, that's wonderful. Trade that for however long it takes. And then after that point, you can obviously start to explore other products. Sorry, it's very early for me this morning, so my brain's not fully working just yet. But yeah, so I think just focusing on a handful of products that you feel comfortable with. A lot of the products do work in a cyclical manner as far as they work within ranges, and you'll see the same patterns the more and more you look at charts. So once you can obviously start to forecast those market movements, that's when you're trading. And then when you're comfortable, then feel free to, I think, start to explore some other products as well. All right. Hopefully that answered that question. I think that might have been it for the questions. Did anyone else have any other questions that come to mind now that we're speaking? And I won't accept a question about why is my voice so annoying. It's because I'm Australian and I'm a little bit sick and it's a little bit early, so I'll get ahead of that one.
Thank you for joining in, Tim. I know it's
That's
super.
okay.
It's like 3 a.m. for you guys right now, right?
Yeah,
Yeah.
3 a.m. Sunday morning.
Yes, I really appreciate this. Thank you so much.
That's
And yeah, if
okay.
you guys have any questions, just feel free to put that in the chat, unmute and ask. With SharmaFX like partnership, that was one of the main things where is provide the transparency and really, really vetted blueberry markets from my side too. And then Tim has always been a great touch point. So I feel like, they provide a lot of transparency. For me, major of the students are like India, Europe, Canada. And so if you're anywhere from there, I know Blueberry Markets does provide services, right? In Europe, Canada, and even India as well. And then for us, it was one of the main things that I understand, just talking to my students and also a lot of you guys on Instagram too, is from a monetary perspective. I talk a lot about start a small account, start like a $500 account. I was just talking about it as well. It's going to make you focus on your risk management. So that's another thing that we kind of worked on with Blueberry Markets. So if you fund your account with a $500 account and you're a Sharma student, then they give you credit $150. So you're essentially trading with $650. Or if you start with $1,000 account, then they give you $300 bonus credit to your account. So you're trading with $1,300. So I think that's great opportunities. I know a lot of people are getting funded accounts. I've never traded a funded account, but we're providing 25% discount on the funded accounts on the SharmaFX student as well. I think there's a question in there for you, Tim, in the chat.
The rule that trading should run. What is on put that up? Okay, great. So look, I did have someone from the Blueberry funded team who was going to join to answer a bunch of questions. I don't think Refat is here or one of his colleagues. If you are, my apologies. If you just want to pop in the chat that you are here as well. If not, what the plan is moving forward is that we will have someone involved from the Blueberry funded side of things. So obviously we would love to continue coming to these boot camps and providing that value. And I do apologize for not being able to perhaps answer the Blueberry funded side of things. Have my work cut out for me on the traditional side. So look, I will get an answer for that for you. If you just want to maybe send me a message with your email, I will get back to you on that when I can speak to someone from the Blueberry funded side of things.
Awesome. It is 3 a.m. I'm not really expecting a lot of people, but we'll do a better job next time. But
yes.
timing.
Yes.
Awesome.
Yeah, so let me come back to you on that one Supreet, and I know, sorry, that it was we did mention that we would have Blueberry funded, and that is the plan moving forward. So yeah, look, Supreet, I'll come back to you on that one once I've got a bit of an idea on that.
Awesome. Any other questions for Tim, you guys?
I just want to let everybody know that, sorry, as we mentioned, there are those promotions being run as well, which I think is going to have great utility. I think with people, trading's difficult. So I think what we've discussed previously is that we want to make sure what we're doing is only helping you as a trader. And what I mean by that is, we are open, we are transparent, and we are available. If you want to speak to me directly, of course you can. And then obviously we've got 24/7 online support as well. So as Blueberry as a company, we've made our name, and what we've made our focus is the customer support side of things. And I think that's why we gel really, really well with SharmaFX and Blueberry. I think we both have the same outlook as to what value we can provide. So again, any sort of questions that do come to mind, feel free to reach out to myself or any of the team directly and take advantage of those promotions. I think they're going to have great ability or provide extra ability with your trading strategies that you're learning through the SharmaFX programs as well.
Awesome. If you want to drop your email, Tim, in the chat, and then everyone can copy and reach out if they have any questions.
Perfect.
Awesome. All right, so let's go ahead and continue. We'll get over to the risk management side. Thank you so much, Tim. I really appreciate it.
My pleasure. Thank you so much for inviting me, and yeah, look forward to doing many more. And yeah, I'll work on getting my voice a little bit more attractive. I just see there's a question there from Kyung. Can we set trailing stop on TradingView? Yes, you can. There is a way in which to do it. So we did release TradingView as far as a tradable platform a few months ago now. So what I'll do is I'll pop through the process to doing that in the chat as well. Yeah. So long story short, yes, you can do trailing stops. You do need to keep the platform open though.
Awesome. All right, thank you. Let's go ahead and continue over to the risk management side, and that would be the last section before we end off the bootcamp. I hope this has been very helpful, and always open to feedback as well. I know it's a lot of information, so I'll send you guys the recording too. But I hope you guys got to take some amazing notes, especially from Tim as well about blueberry markets, and then everything else that we have gone over. So margin leverage, Tim kind of already just discussed leverage and what is all that stuff. Your stop loss, that's your point of exit. Always decide this before getting into a trade. Tim had kind of touched on the take profit side where people will increase their take profit. People do the same thing with stop losses too, right? So if you have already done all your analysis and you have figured out, okay, this is where my stop loss is going to be, that is you saying that according to my analysis, if price reverses and hits this point, then my trade is invalid. A lot of times what people will end up doing is while they're in the trade and price is reversing and the trade is starting to become invalid, they keep increasing their stop loss, or they'll remove the stop loss altogether in the hopes that at some point price will reverse back down and it'll at least bring them to the break even, if not into profits. Don't do that, right? So protect your capital. Don't put that as at risk. Obviously you're doing that when you're trading, but don't blow your account. Don't risk blowing your account. If you have an account, you have the opportunity to continue trading. Don't get into the cycle of I blew my account and then having to refund your account or buying another funded account or anything like that. If according to your analysis, that is the point where your trade becomes invalid, you keep it at that and decide that before getting into a trade. The only time you should be moving your stop loss is if it's moving to break even or trailing your stop loss. Trailing your stop loss means that you're bringing your stop loss into profit. So even if the trade reverses, it still takes you out, but you still get out of the trade profitable. Take profit, that's your point of exit when price has hit a specific amount of profit. So that 1-to-1 that we're doing on Forex, right? Some people do 2-to-1, 3-to-1, 4-to-1. And as you advance within trading, as you get more experience with trading, as you get more experience with simply just executing into the markets and really understanding what's the limitation of your trade. Like for example, we saw 2 examples where price tapped into the daily and weekly resistance. And we knew that was a limitation of our trade based off a 15-minute time frame. A 15-minute break and retest is really not going to blow past the weekly and daily resistance levels unless there's some sort of fundamental driver behind that. Your lot size is the size of your trade. So if you go back to the screenshot that I had earlier into the bootcamp, it was like the $1 lot size right here. You can decrease that to 50 cents. On our trading side, we saw that 2% of that $5,000 account was 92 cents. That's what SharmaFX was showing us here. It's $1 in this screenshot. You can change it to 2 pennies, 3 pennies, 10 pennies, whatever it is, whatever that you're trading with, $2, $3, it doesn't really matter, right? That's your lot size. But the important thing here is understanding what is your risk management and where those percentages. So we're going to go into that too, how to figure out what your position sizing is. The style of trading, I put that within risk management as well, because it's very important for you to understand what is your style of trading. And not everyone is going to fall directly into these 4 buckets. Some people have a mixed strategy. So I started off with, scalping. Most beginners start off with scalping. Few minutes to few hours, just really getting used to just simply executing the markets, how the markets are moving, how to take an entry, how to exit, all that good stuff. Then you have day trading, which is from the market open to market close. So let's say if I enter a trade around 6:30 California time, which is 9:30 Eastern time, New York Stock Exchange open, and I'm holding that out until the New York session closes out. That's still it's not few minutes. It would be considered a day trade there. Swing trade is if I'm holding it out until the next day or the day after. So like few days to weeks. Position trade is, a longer term position trade based off of daily, weekly, monthly time frames, from few weeks to months to years. I have taken a few position trades on USD SEC very specifically a couple of years ago, where I had this trade running for 3 months and I was just scaling in, scaling out, scaling in, scaling out. It was the same exact analysis off of higher time frames. Right, I've had a couple of swing trades this past week when the market opened up on Sunday. I had a pretty good swing trade opportunity on US30. I believe there may have been a question about running through an example of that. I'll go ahead and share that on my Instagram instead, because I know we are a bit over time here anyways. And then type of risk and determining your lot size. So there's risk that's divided up between a static risk, and then you have what they call a dynamic risk. Static risk is what we were just doing here today, for example, where I came in with the 2% risk, I took one position, I took one trade, and then it was predetermined. I knew I was going to go in with 2%, right? And then you have your dynamic risk, which is, again, predetermined. I'm taking one trade, but now I have multiple positions. So you're scaling in, you're scaling out. So if I want to go in with 2%, I could say something like my total would be 2%, but I'm going to take one position with 1%. And then as the trade continues in my direction and I see those lower highs and lower lows formations because we were in zones, then I'll add in another 1%. That would be the dynamic risk. I have multiple positions, but it's the same exact trade here. And then the next thing that you have is your lot size, which is, again, determined by your risk. If I do 2% risk, my lot size is going to be different on that account versus if I do 1% risk, it's going to be different there. That's a quick little formula, but there's a lot of tools, especially with TradingView. I believe there is a component where you can just put in, what is your risk percentage and all that stuff, and it'll give you the lot size. But that is not affected by leverage. That is affected by your risk. How much do I risk? I always say never risk more than 3% of your account balance. Obviously, if you're starting off with a $500 account or a $1,000 account, that means that you're going to be stuck with a penny, 2 pennies, up to 5 pennies, whatever it is, right? You're going to be stuck with that. But 1%, the way I break it down is 1%. It's if I'm new to trading, I'm trying out a new setup, I'm trying out a new market session. If I'm trading out or trying out a new pair, I've never traded fundamentals. Maybe I'm trading that for the first time. I'm going with the 1%. That's my super, super low risk. Then I have my 2%. That's where I keep trading in the most part, right? That's my comfortable space. 2% is your comfortable risk, comfortable setup, same session. I've been trading this pair for a very long time. I understand how the fundamentals will be impacting this. I have, traded this session multiple times. I'm very comfortable with this pair. Right. And that's what Tim was talking about. You become a master of one pair. You're sticking around this 2%. 3% is I'm 100,000% sure that this trade will continue in my direction. I have studied the setup. I have studied this fundamental. I understand how the fundamental analysis aligns with the market sentiment and how is that setting up on the technical side. That's where I'm coming in with my 3%. And 3% is going to be my maximum. The reason why this is important is I'll show you guys on the next slide here. So you both start off with, let's say, $20,000 account, right? The difference here is on one trade, I'm risking only 2%. On the other trade, I'm risking 10% per trade. So now these highlighted boxes is really where I want you to focus on, where with a 2% risk, I'm risking $400 versus with 10%, I'm risking $2,000. You don't really see the changes in that account balance as significant until you really hit the 5th trade, where just risking 2%, yeah, I may have had losses or whatever, but I'm sitting at $18,000 still. Versus 10% by the 5th trade, I'm sitting at $13,000. So that's like almost close to 50% of my account, or just under 50% that I have blown my account, right? That's my account balance, if that's how many losses that you're having. And then by the 9th trade, I'm still sitting at 17% by risking 2%. So I'm still, above that 50% mark, right? But on the other hand, I have blown past my 50% of my account, risking 10% of my trade. So that's why I say stick between that 1 to 3%. So then the main point about trading, investing is preserving your capital, protect your capital, and then build on top of that, right? Now, if I had the loss of capital, if I have 10% loss of my capital, I have to make 11% to get back, just to break even, just to get back to that 10% that I had lost. When I lose 20%, I have to make back 25%. By the time I hit 50%, I have lost 50% of my account. I have to make back 100%. So there's a concept that a lot of people talk about or people get stuck in when it comes to trading psychology, and it is making back losses. This is a reason why if you keep thinking about I need to make back that loss, you're always going to be stuck in that cycle. You got a loss. Think about how you're going to manage your trade. Think about your risk management. Maybe instead of 10%, you fall back to 3%, 2%. That makes sense now, right? You're trading that. So instead of over-risking, over-trading, overdoing any of that stuff, I want you guys to think about this chart, these two charts here specifically, how by the 9th trade, the 5th trade, 9th trade, you've already blown a massive amount of your account, right? If you're risking 10% or above. the growth here may be slow, but at least you're preserving your capital and you're getting slow growth until you hit a point where you've hit a $5,000 account now, or you hit a $10,000 account. It might take a little bit longer, but again, it comes down to being knowledgeable, being educated, really holding on to your bias, everything that Tim said, right? He's saying the same exact thing from a broker perspective. So this should give you guys a very holistic approach and holistic understanding of, I've been trading for 9 years, teaching for 5 years now. Tim is from the broker perspective. So this should give you a holistic understanding of what does this mean from a market perspective. We see a lot of this on like YouTube, social media. A lot of people, they will do that. But the reality of, over trading, over risking, and really becoming a hero in trades is what they call it, is, I'm going to put $200,000 on this account. Let me see if it grows. There's very little people who can actually follow that to the T and still be successful. Because as human, like Tim was talking about, you're going to increase your TP. I was telling you guys about the stop loss. People increase their stop loss as well. As human, we don't like to be wrong, right? And we always want to make back those losses. We think we can do that. Realistically, you would need to make back, if I lost 50%, I'm not making back 50% just to hit my break even. I have to make back 100%, and then I'm hitting break even. That puts a lot more stress on you. So the key points here for your risk management is treat trading, investing like a business. How would you treat your business, right? You're not going to hero all out on one investment, right? You're going to treat it like a business. You're going to make strategic approaches. You're going to come up with a plan, and you're going to adjust your plan according to the new data that you're getting. Protect your capital before you try to compound your account. Again, don't go in with a $500 account. I'm going to go in with, a dollar lot or whatever. Like, I'm going to try to hero this and flip this in one trade to $1,000 account. Your goal is from $500 account, even if you're making $20, $30, is small increments, but the fact that you're also proving that your analysis is right, that's the main thing, right? Really find that highest probability setup that you're looking for. Really increase the gaps that you have, or fill in the gaps and increase your knowledge. If you're great with technical analysis, but you don't really understand how fundamentals will set up your market sentiment, then that is something that you need to study up on, right? Understand how fundamentals, what kind of fundamentals are coming out, what kind of fundamentals are impacting your pair, and then how is that setting up the market sentiment, right? Backtest, watch the markets live. So instead of actually placing a live trade when NFP comes out or CPI comes out and you've never traded that before, you're watching the live markets, you're still on the charts, you're collecting data, you're collecting knowledge, you're trying to see what is happening here. And again, all the economic data, it's not that one is necessarily good or the other is bad. It's all subjective to where you are in the economic cycle and what does it mean for the overall economy. Less is more. So you don't want to be trading a lot. I know a lot of people who take 20, 30 trades in a week, or they trade, they take 20, 30 trades in a day. You don't want to do that. Stick to a rule, 2 to 3 trades per day, and that's pretty much it. Right? I think 3 trades is still a lot, but stick to 2 trades a day, right? That's going to force you to focus on the highest probability setups. When you're taking 20 trades a day, you're doing, what Tim was talking about, you have one bias and then you're like, okay, I'm going to try to catch the second one to make up that loss. You get into another loss there and then you get into a third one and then a fourth one, a fifth one. And by the time you've already hit your third or fourth trade, you're already frustrated. Right. So instead, focus on 1 to 2 trades. If I know that I am only allowing myself to take 1 to 2 trades, I'm not going to be catching every move. I'm going to be looking at what is the market structure? What is the news? If there is news coming out, what is a market sentiment? Are we risk on? Are we risk off? Are we looking at more of the flows into safe haven currencies versus into the risk currencies? Am I looking at a longer term trade? All those different factors that we talked about today. You're going to think about that, and then you're going to look at what is my probability of this trade working out. If it's sitting in consolidation, you don't want to be trading that, right? If you see that it broke out of consolidation, establishes support, and it's going to keep pushing, that's your trade opportunity there. So focus on probabilities of a setup playing out. The ways that you do this, backtest your setups. A lot of people talk about don't backtest, it messes with your trade, it gives you false hope, this and that, whatever. I think you need to go in with an objective of what you are doing. Understand the market is not going to give you, if there was a 20-point move on Monday, it's not going to give you the same exact setup with a 20-point move on Wednesday with the same exact break and retest, with the same exact level, with the same exact, candle structure. There are going to be different variations of it. But when you go in with the objective of, I'm trying to test out my risk management, what does my 2% risk look like on this trade versus my 10%, right? Obviously, you shouldn't be doing 10%, but I'm going off of 10% off on that chart. If I'm going based off of what market session should I be trading according to my pair? If I'm trading GBP, JPY, when does it move the most, right? Things like that. So have an objective when you're going into your back testing session. All you're doing is collecting data. And then you're looking at your sessions again, your risk, all that stuff, back test, all that things before you're executing in the live markets. So that's pretty much it for today. Are there any questions that you guys have for me? Again, feel free to tag me on Instagram at SharmaFX. And then we still have our mentorship. The spots are open, so feel free to just go onto the website and sign up there. And then, of course, we have the benefits with Blueberry Markets as well and Blueberry Funded. Any questions from today? Was it helpful?
No question. Just I really appreciate all the information you've given. I think it was very, very helpful.
Absolutely. I appreciate that. All right, awesome. So thank you so much for joining in, and I'm sure like taking out 3 hours from your weekend is definitely an investment of its own. So I really appreciate you guys. As always open to feedback. If you guys have any questions, feel free to reach out to me on Instagram at SharmaFX. I'd be more than happy to answer any questions. But other than that, I will see you guys for the weekly outlooks on YouTube and Instagram. And I hope you guys have an amazing rest of the weekend.
Thank you so much.
Yeah, have a great one.